Hi guys, good morning to all of you. So how are you? I hope you all must be fine. So let's first talk about the Ind AS names and numbers, right? Let's first talk about the Ind AS names and numbers. Okay, quickly we shall talk about the names and numbers. Ind AS 1, presentation of financial statements. Ind AS 2, inventories. Ind AS, this is for your reference. I'm not looking into this. This is Ind AS 7, cash flow statements. Ind AS 8, accounting policies, changes in accounting estimates and errors. Ind AS 10, events after the reporting period. Ind AS 12, income taxes. Ind AS 16, Ind AS 16, what? Ind AS 16, property, plant and equipment. Property, plant and equipment. Ind AS 19, employee benefits. Ind AS 20, government grants and disclosure of government assistance. 21, the effects of changes in foreign exchange rates. 23, borrowing cost. 23, borrowing cost. 24, related party disclosures. 24, related party disclosures. 27, separate financial statements. 28, investment in associates and joint ventures. 29, what is 29? Please tell me. 30, 31, no. 32, I'm waiting for a response. 29, 32, financial reporting in hyperinflationary economy. Sorry, sir. I asked. Okay. 29 is financial reporting in hyperinflation economy. Please tell me about 32. 32. 32. 32. 32. 32. 32. 33 is EPS, which we are currently continuing with. ठीक है ना? 33 is EPS. Okay. Okay. 34, hyperinflationary. 34, interim financial reporting. Interim financial reporting. Financial instruments present. Financial instrument presentation. Very good. 32, financial instrument presentation. 36, impairment of assets. 37. 37. 37. 37. 37. 37. 37 is what? Provisions, contingent assets and contingent liabilities. 38, intangible assets. 40, investment properties. 41, agriculture. 101, first time adoption of Ind AS. 102, tell me 102. Tell me 102. Tell me 102. 103 is business combination. 104, insurance contracts. Tell me 102. Share based payment. Pooja, very good. Very good. Okay. 104, insurance contracts. 105, non-current assets held for sale. 106, exploration for or evaluation of mineral resources. 107, financial instruments disclosures. Okay. One zero eight, operating segments. Operating segments. 108, operating segments. When a company has so many segments, other businesses classified into so many segments, then how to report the segments? Ind AS 109, financial instruments measurement. As far as now financial instrument is concerned, we have 3 Ind AS: 32 presentation, 107 disclosure, 109 measurement. So operating segments 108, 109 financial instruments. Anybody who will tell me about 110? Anybody? Riza, very good. Consolidated financial statements. Consolidated financial statements. So 108 is operating segments, 109 financial instruments measurement, 110 consolidated financial statements. Okay. Now come to here. Acha. What about the homework? First of all, let's discuss the homework. Question 2 was homework. Is it done? Question 2 was homework. Is it done? Any problem? Any doubt on question number 2? Any doubt on question number 2? No. Question number 2, if I am not wrong, question number 2 was based on right issue. Question number 2 was based on right issue, if I am not wrong. Okay, so you don't have any problem in that. Very good. Third was already done in the class. Fourth, again a right issue question. Done? Fourth is done? Great. Great, great. Okay. Any other homework? Any other homework? I think it was yes. You must, the homework was to read this paragraph. Dilutive, non-dilutive, how to calculate DEPS, following calculation is required. And yes. Sir, illustration 15, can you please explain? 15, 16. Acha, okay. These two were the homework. Okay. 15 DEPS doubt, sir. Okay. Question 15 not clear. Okay, let's talk about question number 15, not an issue. Calculate BEPS and DEPS from the following information. Profit after tax 15/16, 5 lakh. Equity shares as on 1/4/15, 40,000. 12% convertible preference shares on 1,415. Rupees 10 lakh. Face value 100. Convertible on 1,116. 1,116. 2:1. 13% convertible debentures on 1,4 as on 1,415. 5 lakh. Convertible after 2 years into 3:1. Okay. 15 is not clear, na? Okay, 15. First of all, BEPS calculation. BEPS calculation. Under BEPS calculation, earning available for equity shareholders will be, can you please tell me the answer? What is EAESH? If I am not wrong, it should be 5 lakh minus minus 90,000. So 4.1 lakh, very good. 4.1 lakh. Okay. Acha. The second thing I am asking is weighted average. Weighted average. Equity was 40,000 into 12 by 12 plus, see guys, preference shares, convertible preference shares as on 1,415, convertible on 1,116. Guys, they are converted into the same year. Please look into the question. They are converted into same year, and from with effect from 1st January they become the equity. January, February, March. 2:1. That means for everyone you will get 2 shares. So these are 10,000, so 20,000 shares. So 20,000 shares into 3 by 12. This is 45,000. So finally, our BEPS should be 9.11. Our BEPS should be 9.11. DEPS calculation. As far as DEPS calculation is concerned, again, what will be our earning? It will be 410. It will be 410 plus 90,000. 90,000 is saving. Sorry. Saving in preference dividend. 90,000 will be the saving in preference dividend. Sir, how come? This is the 90,000. See, we deducted 90,000 because it was a preference dividend for 9 months. ठीक है ना? And these convertible preference shares were outstanding since beginning. So if they were outstanding since beginning, they were potential equity since beginning, and they were actually converted into 1st January. So they were potential equity till 1st January. After 1st January, they are actual equity. So basically, they were potential equity from 1st April to 1st January. 9 months. So if their dividend, so suppose if they become equity only from 1st April onwards, the dividend would have been saved. Okay. Apart from that, there are convertible debentures. 5 lakh rupees, 13%. 5 lakh into 13%, 65,000. I think the tax rate is not given. So due to that, a tax would be saved. Due to that, saving in interest. But you know very well that we generally used to make a calculation of incremental borrowing, incremental EPS. Incremental EPS. So what is incremental EPS? First of all, let us calculate incremental EPS. Convertible preference shares. Convertible preference shares. 90,000 is saved, would have been saved on conversion. Divided by preference share conversion is 20,000. And they were potential for 9 months. Now, see, the base is same. In the numerator, 9 months dividend could be saved. Denominator, 9 months weighted average is there. It's 6. Guys, are you getting my point? Convertible debentures, 65,000 interest could have been saved. And what are the potential equity? 3:1. So 5,000 into 3, that means 15,000. 15,000 into 12 by 12. Now why 12 by 12? They were outstanding since beginning till end. They were debentures till end. So they were potential for the entire year. $4.33. I think the tax rate is not given. Here the tax rate is not given. Okay. So we are ignoring the tax effects. So now this is rank 1. This is rank 2. Guys, please comment. Are you getting my point or not? Did you find your mistake, or like you have done the same things? Did you find your mistake or you have done the same thing? Tell me. Rank 1, debentures, 65, 15. $475, 60. It's 7.917. Preference shares, it should be 90, it should be 15. Guys, did you find your mistake? or you did the same things, same treatment. $7.53. What is the answer? 7.53. It is correct. So your DEPS would be 7.53. I think you must have wrongly treated this one, preference share, I think. This convertible preference share, you must not have correctly done it. You must have done some mistake in this preference share, Hana? If I am not wrong, you must have done some mistake in the preference shares. Okay, you can write this. Okay, you can write this. Okay, shall we move on? What about illustration number 16? What about illustration number 16? Do I need to try this also, or you have done this, you don't have any doubt what to do? Done. Okay. So illustration number 16 is done. Mark it, illustration 15, mark it as exam question. Okay. Have you read this paragraph? Have you read this paragraph? Because now I am not going to read this one and this one, because in the yesterday's session, in the last session, whatever we discussed about diluted earning per share through one example, not one, through 3 examples, everything is written here. Everything is written here. So I am not going to discuss all these paragraphs, all these points, because I have already discussed the same through explanation of 3 examples. So yes, but if you want to ask any particular doubt on a statement, any doubt on a particular statement or particular things, I'll definitely discuss. I'll definitely discuss. Do you want me to read or to discuss some of the points, or they are totally clear? Please tell me. These are the same steps which we followed in our examples. Basically in our example number 3. Okay. No? It's fine, sir. Clear, sir. Very good. Okay. It's fine. It's fine. It is very important. I have already covered this through the example. Okay. This will be your homework, and this is a basic question. This is a basic question. 14 number will be your homework. 14 number will be your homework. 15, 16 done. Okay. Now, as far as illustration number 17 concerned, come to this question. Come to this question. Come to this question. Entity A has in issue 25,000 4% debentures with a nominal value of ₹1. The debentures are convertible into ordinary shares at the rate of 1:1 at any time until 2019. ठीक है. Entity's management receive a bonus based on 1% of the profit before tax. ठीक है. Before tax. I think, if I am not wrong, the answer may be wrong. If I am not wrong, the answer may be wrong. Entity A's result for 2012 showed a profit before tax 80,000 and a profit after tax of 64,000. For simplicity, a tax rate of 20% is assumed in this question. Calculate earnings for the purpose of diluted EPS. Guys, can you please solve this question? They are saying that company's earnings before tax is 80,000, after tax is 64,000. $25,000 debentures convertible into 1:1. Management receives a bonus based on 1% of the profit before tax. I am definitely sure that this question solution is wrong. Let me check. I have solved this question. Yes, this is the one. Correct. See, our profit before tax was 80,000, right? Our profit before tax was 80,000. The management is entitled to a bonus of 1% for profit before tax. So, bonus of 1% will be deducted from 80,000. Bonus of 1% will be deducted. Then 79,200 will be the final profit before tax. Then the tax will be applicable at 20% and it will be, the PAT will be 63,360. This is the earnings for the purpose of basic earning per share. Now, this is earnings for the purpose of basic earning per share. What we will do? We will add back the saving of interest after tax. It is 800. How come 800? The original interest, if I am not wrong, the original interest was 4% of 25,000. So 25,000 into 4%, it was 1,000. It was 1,000 and 20% tax rate is there. So minus 20%. So ultimately the net of tax saving is 800. Net of tax saving is 800. When the net of tax saving is 800, your profit before tax would have been changed. Your profit before tax would have been changed. Simple. Suppose if the interest would not have been paid, the profit before interest would be changed and ultimately the bonus would be changed. Understood or not? The bonus would have been changed. So the effect of bonus will be 8. Effect of bonus will be 8. How? See, the interest have been reduced. The profit have been increased with the amount of interest, that is 1000. On such 1000, the bonus will be eligible, 10 rupees. And on such bonus, tax rate will be applicable. So finally, 8 rupees bonus needs to be paid extra. So this is the earnings for the purpose of diluted earning per share. This is the earning for the purpose of diluted earning per share. Guys, please see this. Please see these two working. First of all, the working is clear or not? Since the bonus was to be calculated on the profit before tax, if you are saving with the interest, if you are saving the interest amount, the profit before tax can be changed. If the profit before tax can be changed, the bonus will be included. The bonus could be changed. Understood? Understood? See this. The 80,000 was the profit before tax. If the interest could have been saved, it should be 81,000. On 81,000, the bonus should be 810. We have already covered 800 bonus here. So the increase in bonus is 10 rupees. Increase in bonus is 10 rupees. Now you have got earning for the purpose of basic earning per share and earning for the purpose of diluted earning per share. Now, they are only asking for the earning, I think. Okay, calculate earning for the purpose of diluted earning per share. They are just asking the earning for a purpose of diluted earning per share. They are not asking diluted earning per share because in this question, number of equity shares are not given. How many number of equity shares or ordinary equity shares are given? It is not given. So illustration number 17 is that. The answer here, the answer is 64,792. The correct answer should be 64,152. It should be 64,152. Exam. Do you have any doubt on this illustration? Okay, now I want you to try this question. First of all, I will read the question and you guys have to try it right now. ABC has 10 lakh rupees. ABC has 10 lakh rupee 1 ordinary shares and 1000 rupee 100 10% convertible bonds issued at par, each convertible into 20 ordinary shares on demand, all of which have been in issue for the whole of the reporting period. ABC Limited shares Price is 4.5 per share. Earning for the period was 5 lakh. Earning for the period was 5 lakh. The tax rate applicable to the entity is 21%. Calculate basic EPS, earnings per incremental share for the convertible bond and diluted EPS. Ultimately, in this question, there is only one potential equity, which is a bond. Now, you just need to solve this question. As far as basic EPS is concerned, it is very simple. It is quite simple. You just need to focus on the diluted earning per share working. So, please try to attempt this question right now. I am waiting for a response. Okay, I think it's quite simple, right? So 18 is done. Only the interest portion is to be saved, like 1000 into 100 into 10%, 10,000 minus 21. 7900 interest would be saved. Then 1000 into 20, 20,000. 7900 divided by 20,000, it's 0.395 incremental. 0.395 incremental. Okay, I think it is quite simple. Correct. Now, illustration number 18 is done. Come to the next point of DEPS only. We are continuing with DEPS only. DEPS is our last topic, but under DEPS there are so many subtopics. Now, call options issued or returned by the entity. Call options. Now, what do you mean by call option? Call option. In the last sessions, we discussed about call and put option. You remember that? We discussed about call and put option. You remember that? What do you mean by call option? What do you mean by call option? Call. Call means to buy, to repurchase. Call means to buy, to repurchase. To buy, to repurchase. This is call option. Okay. Now, what is the basic issue? See, call option shall be considered for the calculation of DEPS only when they are in the money option. In the money option. That is, they are dilutive. When exercise price offered is lower than the market price of the share. The exercise price offered is lower than the market price of the share. Okay, now try to understand. Suppose I have given you an option to buy. Jaii sir has given an option. Let me check who is available currently. Okay, Pooja. Jaii sir has given an option to Pooja to buy shares from Jaii sir at 500 each in the next month. Suppose in next month market price of share is 600 each. Now I just want to ask you whether Pooja will avail this option or will not avail the option. Tell me whether Pooja will avail this option or not. Jaii sir has some shares. Jaii sir has some shares of the company. Now Jaii sir has given an option to Pooja that Pooja, I am ready to sell these shares to you at 500 only. At 500 only. ठीक है ना? But this option is for the next month. Now in the next month, the actual share price of the market price of the share is 600 and Jaii sir has given an option to purchase the shares at 500. Tell me whether Pooja will decide to purchase the shares at 500 from Jaii sir or it will not decide, or Pooja will not decide. Definitely Pooja will exercise the option. Definitely Pooja will exercise the option. Understood or not? Pooja will definitely exercise the option. She has to buy. She has to buy. Understood or not? Because she is getting benefit. She is getting benefit. So under options, under option contracts, when the holder is in favorable condition, then only the holder applies. When the holder is in unfavorable situation, holder will not apply or holder will not exercise the option. So same goes on with this. Now please try to read this. This is called, in our example, it is called in the money option. In the money means the holder is getting benefit. The holder is in favorable situation. It is called in the money. And that is why it is here written in the money option. Call option out of the money are to be ignored while calculating DEPS. Out of the money options means option is not in favor of the holder. Now potential equity shares are calculated as under. Now how to calculate potential equity share? How to calculate potential equity share? Try to understand. Suppose I have given an option to Pooja to buy shares from Jaii sir at 500 each. 1000 numbers. 1000 numbers. So technically proceeds expected from Pooja. How much proceeds I will get? 1000 number into 500. That is 5 lakh. Now 5 lakh, what is the real market value of the share? Real market value of the share is 600. So 5 lakh is divided by 600 is 8.33. Oh sorry, 833. Is 833. Is 833. $833. That means out of 1000 shares, we are getting actual value for 833 shares, and for 167 shares, we are not getting any value. So these 167 shares are potential equity because the option is not yet exercised. The option is not yet exercised. It is to be exercised in the next month, and I am expecting that the market price will be 600. So once again, I have given an option to Pooja for 1000 number of shares. 1000 number of shares. Out of these 1000 number of shares, definitely I will get 5 lakh rupees. But the real value of 5 lakh rupees is based on 833 shares. So technically I am issuing 167 shares extra in the future, for which I am not getting any funds. So these are potential equity for which we are not getting any funds. This may dilute your basic EPS. This may dilute your basic EPS. Guys, have you understood the point? Do you understand the point? Please read this example. Please read this example. Read this example. You will get to know. Read this example. I am here only. Please read this example. Okay, tell me, any doubt on call option issued by or written by the entity? Any doubt you have? Let's come to this question. Illustration number 19. Company has issued 500 options with an exercise price of 40 each. With an exercise price of 40 each. The average market price of the share during the period was 50. Okay. See, the market price is 50, but company issued the 500 options at an exercise price of 40. It is in the money option. It is definitely in the favor of holder. Find out whether the option will be treated as dilutive or not. Yes, definitely it will be treated as dilutive. 500 into 40. What is the proceeds? 20,000 divided by 50. 400. So 500 minus 400 is equal to 100. So 100 is the option. 100 is the option. One hundred is the option. 100 is the potential equity, dilutive. Dilutive potential equity. Okay, let's read illustration number 20. Read this, cover this. Illustration number 20. Okay, done? Done, guys? Clear? Okay. Come to this question, illustration number 22. Come to this question, illustration number 22. Illustration number 22. Come to this question, illustration number 22. Illustration number 22. Profit attributable to ordinary equity shareholders of the parent entity 12 lakh. Weighted average number of ordinary shares outstanding 50,000. Sorry, 5 lakh. So 12 lakh divided by 5 lakh. It's 2.4. It's 2.4 basically basic EPS. Average market price of one ordinary share 20. Average market price of one ordinary share is 20. Average market price of one ordinary share is 20 rupees. Okay. Weighted average number of shares under the option is 10,000 share, 1 lakh shares under the option. Exercise price for the share for shares under option is 15. That means 10,000, sorry, 1 lakh into 1 lakh into exercise price. So the proceeds will be 15 lakhs. Proceeds will be 15 lakhs. Divided by proceeds will be 15 lakhs divided by 20, the market price. $75,000. So out of 1 lakh, 75,000 options are non-dilutive. They are not potential, they are potential but not dilutive, because for 75,000 shares we are getting the proceeds. 25,000 shares are potential and dilutive. We are not getting any funds for 25,000. Calculate basic and diluted earning per share. So diluted earning per share will be like 12 lakhs divided by 5 lakh and 25. 5 lakh and 25 share. 5 lakh 25,000. Okay. Five lakh 25,000. How much? It's 2.29. It's 2.29. It's 2.29. Yes, it's 2.29. Correct? So this is illustration number 22. This is illustration number 22. This is illustration number 22. Correct? Clear? Let me check this question first of all. Okay, let's come to this question. Illustration number 21. Let's come to this question. Illustration number 21. Illustration number 21. Let's come to this question. Illustration number 21. Illustration number 21. Okay, let's start reading. At 30th June 2011, the issued capital of the entity consisted of 15 lakh ordinary shares of 1 rupee each. On 1st October 11, the entity issued rupees 1250 of 8% convertible loan stock for cash at par. This is basically a potential equity. Basically, it is a loan, but it is convertible. 1250 of 8% convertible loan stock. Each rupee 100 nominal value of the stock, loan stock, may be converted at any time during the year ended 2016 to 2019. That means from 16 onwards, it may be converted at any time. Maybe in 16, maybe in 17, maybe in 18, maybe in 19. Into the number of ordinary shares set out below. If they are going to be converted in the year 2016 only, they will be converted into 135 ordinary shares. Each 100 rupee loan will be converted into 135 ordinary share if converted in 2016. But if it is converted in 2017, it will be converted into 130 ordinary shares. If in 18, it will be converted into 125. If in 19, it will be converted into 120. Okay. If the loan stocks are not converted by 19, they would be redeemed at par. And suppose if the loan is not converted in 2019, then we will redeem it in cash at par. They are not going to be converted after 19. This illustration assumes that the return equity of conversion option is accounted for as a derivative liability and marked to market through the profit or loss. I'll discuss this. What is derivative liability and mark to market? The change in the option fair value reported in 2012 to 2013 amounting to loss of 2500 and 2650 respectively. Now, please first of all highlight this point. This illustration assumes that return equity conversion option is accounted for as a derivative liability and marked to market through profit or loss. The change in the options fair value reported in 2012 and 2013 amounting to loss of 2500 and 2650 respectively. I will discuss this highlighted point, don't worry. It is assumed that there are no tax consequences arising from these losses. The profit before interest, fair value movements and taxation for the year ending June 30, 2012 and 13, 825 and 895 respectively, and relate wholly to the continuing operations. The rate of tax for both the periods is 30%, 33%. Calculate basic and diluted EPS. This is a very good question practically. Now, what is this highlighted portion? What is this highlighted portion? Let us read this once again. This illustration assumes that return equity option, return equity conversion option. Now, please try to understand. We have issued loan stock, and these loan stock, on such loan stock, entity has given option to lenders to convert entity has given option to lenders to convert these loans into equity, to convert these loans into equity. to convert these loans into equity. Guys, understood or not? So they become what they become? They become return equity conversion option. So these are equity conversion options. Now they are treated as derivative liability. Derivative liability under Ind AS 109. Now what is this derivative liability? See guys, derivative is any instrument whose value is determined based on some underlying. Here the loan instrument is a derivative whose actual value is based on the underlying, and the underlying here is ordinary equity share. Technically, today we have issued the loan, but its overall value depends on the equity, because it is we have given the option that the loan holder, the lender can convert it into equity, into various number of equity shares on different dates, 135, 130, 125, 120, right? So this loan is considered as derivative liability. Now as far as derivative is concerned, I will explain this derivative in very detailed form under financial instrument topic. So even if you couldn't understood that why this is a derivative liability, what is derivative, please leave and ignore, because when we try to when we start reading financial instrument, it is my responsibility to cover the derivative, to make you understand the derivative, what is derivative. Now please let us understand that, okay, as per the question, it is a derivative liability. What to do now? Now as per Ind AS 109 says, if any derivative liability is there, you need to fair value such liability at the year end. You need to fair value such liability at the year end. That means remeasurement, like it is as good as Ind AS 16 property, plant and equipment. At the balance sheet date, we need to remeasure the property, plant and equipment, revaluation gain, revaluation loss. You remember? So just like same, the derivative liability at the balance sheet date, the derivative liability needs to be remeasured, and these are the fair value gains and fair value losses. The change in the option fair value reported in 12 and 13 amounting to loss of 2500 and 2650. Amounting to loss of 2500 and 2650. These are basically the fair value losses. Okay. And it is assumed that there are no tax consequences arising from these losses. No tax consequences. That means these fair value losses are not tax deductible at all. That means these are permanent differences. No DTA DTL concept will be there. Don't worry. So no tax consequences will be there. These are not tax deductible for sure. Okay. Apart from that, they have given you 8,25,000 earning for the year 2012 and 895 earning for the year 2013. But these earnings are before interest. What is interest? Interest is on the loan. Before fair value movements, that is before these losses. Before taxation. Okay, before taxation, the tax rate is 33%. So everything is fine. I think everything is fine. Don't worry. Everything is fine. First of all, what I have discussed till now, have you any doubt? Do you want to ask anything? Do you want to ask anything? Do you want to ask anything? So far clear. Okay. Now please come to the working part. Please start with the calculator. Take the calculator, right? Now we have we have 8,25,000 earning before interest, before fair value loss and before tax. So 825. First of all, what we will do? We will deduct the interest. Now, as far as interest cost is concerned, first of all, based on the reading of the question, it seems that 30th June 2011 is the year ending, or we can say year beginning. Like the year, this is not the calendar year, this is not the normal financial year. This is this year ends on 30th June every year, I think, based on the proper understanding. Okay, so considering this fact, on 1st October 11, we issued the loan. October. So October, November, December, January, February, March, April, May, June. So in the first year, only 9-month interest will be paid. Only 9-month interest will be paid. So 1250 into 8%, 1 lakh into 9 divided by 12, 75,000. So see this. See this. 825 was the earning. 825 is the earning. 75,000 is the interest on loan stock. Now fair value movement 2500. So 2500 is the fair value movement, fair value loss. Okay. Now you got profit before tax. But the tax will not be calculated on this figure because above fair value loss is not tax deductible. So for tax purpose, 825 minus 75 only. $825 minus 75 only. $75 only. Okay. And now the tax to be calculated, $247,500. So it's $247,500. Guys, have you understood the same? For tax purpose, the profit is 7,50,000. You will apply 33% tax rate. You will get 2,47,500. Finally, you got profit after tax. Divide by number of shares, 15 lakh. I think they were 15 lakh, na? Yes, 15 lakh. 15 lakh number of shares. The earning per share, the basic earning per share is 33 paisa. The basic earning per share is 0.33. Please tell me, any doubt in this working? And please make the same working for the next year, 2013. Please do the same working for the next year. For the next year, the interest will be charged for the whole year. That is 1 lakh. The interest will be charged for the whole year. Please see the next working. Okay, clear? Now, this working is fine. Now let's come to what we call it. Let's come to diluted earning per share. Now, as far as diluted earning per share working is concerned, DEPS calculation. DEPS calculation. First of all, 2012, right? As far as DEPS calculation is concerned, you need to consider few things like this interest would be saved 75,000. Okay, this interest of 75,000 would be saved. Next, if this loan gets converted into equity, it will not be a derivative liability. And if it is not a derivative liability, then there will not be any fair value loss. There will not be any fair value loss. Simple. So, consider few things. First of all, if the loan gets converted into equity, there would not be any interest. If the loan gets converted into equity, it is not a derivative liability, no more derivative liability. So, no loss, no fair value loss. Okay. Next, if the loan gets converted into equity, it will be converted into 135 ordinary shares. Now see, in this question, they have given option for conversion from 16 to 19, but we will consider the worst situation. The worst situation is 2016. Like in 2016, maximum shares are being issued. Maximum shares will be issued on conversion, that is 135. We will consider the worst situation, that is 135. Okay, that is 135. So what are the few points? First, the interest would be saved, but obviously the after tax effect will be taken. The fair value loss will not be there now, but no tax effect is to be given. Then the conversion will be 135 ordinary shares. Understood? So considering this fact, okay, let's discuss considering this fact. Technically, the saving would be 75,000 minus 33%. Sorry, 75,000 minus 33% and 2,500 fair value loss. Overall saving is 52750. This is your saving. This is your overall saving. Now, conversion. Can you guys please tell me how many shares will be issued on conversion? For every 100 rupees nominal value of loan, we are going to issue 135 shares. For every 100 rupees. For every 100 rupees nominal value loan, we are going to issue 135 ordinary shares. So tell me how many number of shares will be issued? Tell me. Waiting for a response. Waiting for your response. Please tell me. One 1,687,500. See, the loan amount is 12,50,000. It's 12,50,000, na? Ha. For every 100 rupee, I will give you 135 shares. That means 16,87,500. And these loans were issued on 1st October. This loan was issued on 1st October. You remember? So technically, into 9 by 12, this is outstanding. This is potential equity and outstanding for the 9 months. One 265 625. 1265 625 1265 625. Let me check again. Am I right or not? Yes, correct. So incremental EPS will be 52750 divided by 1265 625. 52750 divided by 1265625. It is 0.04. It is 0.04. The incremental EPS will be 0.04. The incremental EPS will be 0.04. Understood or not? This is for 2012. You can also calculate for 2013 also. Please try to calculate for 2013. Guys, please try to calculate for 2013. Try to calculate for 2013. Yes, for 2013. Point 041. Okay. 0.041. All right. All right. 0.041 Pooja. 0.041. Okay. Okay, so for 2012, what will be the diluted earning per share? For 2012, what will be the diluted earning per share? Basic earning per share earning was 5 lakh plus 52,000. Sorry, 52,750. 52,750. 52,750 plus 52,750 52,750 divided by 15 lakh plus 1265 625. 552, 750, 27, 65, 625. Point 199 or 0.20. See this, 0.20 paisa, 0.20 paisa, 0.20 paisa. It is basically 552, 750. It is 1265, 625, 2765, 625. It is 20 paisa. Now please calculate for 2013. Guys, please calculate for 2013. I am waiting. Point 188. 0.188. Is there any network issue? Yes, there is a network issue. 1 second, 1 second. Okay. So 0.188, right? So it should be tentatively 19 paisa. It should be tentatively 19 paisa, right? Okay. So now tell me, any doubt on this question? How was this question? You should mark it for exams. You should mark it for exams, right? Contingently issuable shares is remaining part. ESOP is remaining part. Guys, any doubt? I am waiting for a response. Any doubt? I am waiting for a response, guys. Okay. So illustration number 21 over 22 over. Let's leave this for the time being. Employee stock option. It is similar. It is similar to call options. Similar to call options. You remember? We just discussed the call options. This one, same to same. First of all, calculate the proceed, divide it by market price. You will get the numbers, non-dilutive portion out of total option minus non-dilutive portion, you will get the dilutive portion. Simple. So it is same. It is similar to call options. Similar to call options. Number of options under ESOP into exercise price divided by market price, you will get the non-dilutive portion. Out of total options, deduct the non-dilutive portion, you will get the potential dilutive earnings. Understood? So you just need to read this as a homework. I may discuss it in the next class, but now this is similar. Okay, now let's come back to this thing. Contingently issuable shares. Contingently issuable shares. Acha, before discussing this, let me check, is there any important questions? Okay, let's discuss some of the questions now. Let's first of all discuss some of the questions. Let's first of all discuss some of the questions. Let's discuss some of the questions. Question number 5. From questionnaire, question number 5. Question number 5 from questionnaire. On 1st January, shares in issue 10 lakh. 5% convertible bond, rupee 1 lakh. Terms of conversion 120 ordinary shares of 100 for rupees 100. 31st March, holders of 25,000 bonds, above convertible bonds, converted into ordinary shares. Profit for the year ended 31st December, rupees 2 lakh. Tax rate 30%. Oh, sorry. Calculate basic and diluted earning per share. Ignore the need to split the convertible bonds into liability and equity. Okay, not an issue. So, you have already ordinary shares of 10 lakh. You have the profit of rupees 2 lakh. Okay, 2 lakh divided by 10 lakh, you will get the basic earning per share. Now, you have convertible bonds. You have convertible bonds of rupees 1 lakh. These are convertible into 120 ordinary shares for rupees 100. terms of conversion 120 ordinary shares for rupees 100. ठीक है. On 31st March, that is after 3 months, 25,000 bonds were actually converted. Okay. So technically, for starting 3 months, the interest on bonds will be on overall 1 lakh. Then, for remaining 75,000 rupees, the interest will be calculated. Can you please do this question, or you want me to solve the question? Can you please try this question right now? Or you want me to try the same together? Because it seems very simple question. Tell me. It seems very simple question. It seems very simple question. Tell me. We'll try. Okay, try it now. Immediately. Try it now. Guys, I am waiting for a response. I am waiting for a response. I am waiting for a response, guys. Okay, let me complete this because you guys are actually taking much time. See guys, this is our final profit. When they say profit for the year, always assume that it is after tax. Always assume that it is after tax. Okay. When they give you the profit for the year, then always assume profit after tax. Guys, are you listening to me? Are you listening to me? So this is profit after tax. Okay. Now as far as this 120 ordinary share is concerned, it is to be converted for every 100 rupees. So finally I am working on DEPS calculation. I am working on DEPS calculation. I am working on DEPS calculation, right? Now try to understand, rupees 1 lakh is convertible bond. Now let us divide this into two parts. Rupees 25,000, rupees 75,000. 25,000 is converted on 31st March. And this is not yet converted. This is not yet converted. So as far as this 25,000 is concerned, the numerator, that means saving in interest, could be for 3 years only, 3 months only, like 25,000 into 5%, into 3 by 12 and 70%. 25,000 into 5% into 3 divided by 12 minus 30%. It is 218.75, matlab 219. This could be the saving. Now what is the denominator part? the denominator part is 25,000 divided by 100 into 120, like 30,000. 30,000 into 3 by 12. So 75,000 could be the potential equity. Now same working to be done in this respect. Saving would be 75, 5% for the whole year into 70% after interest. That is 2625. And number of potential equities, 75 divided by 100 into 120. Into 120, $90,000. So overall 2625 plus 219 divided by 7,500 plus 90,000. 0.029 is your incremental EPS, and the same would be considered with the basic earning per share working. You will get the answer. You will get the answer. You will get your answer. Don't worry. If the same to be considered along with the basic PS, you will get the answer. Please tell me, have you done any mistake? Have you done any mistake? Since I was not getting any answer from your side. Sir, didn't get weighted average shares for diluted. Now, didn't get weighted average. See, 25,000 is the loan portion. For every 100, you will get 120 numbers. So, it will be 30,000 shares. Now, 30,000 shares were potential from January to March only, because they become actual share from April onwards. So, they were potential only for 3 months. And here, these are potential for the entire 12 months, 90,000. There was some confusion. Okay, not an issue. There was some confusion, but okay, it's okay now. Now, what was your basic earning per share working? It was, I think, 10 lakh and some 22,000 and 2 lakh. Okay, so 2 lakh plus 2625 plus 219 divided by 10 lakh, or not 10 lakh actually. It's 10,22,500 plus 97,500. The diluted EPS will be this. The diluted EPS will be this. Diluted EPS will be this. Okay. Diluted EPS will be this. Okay. Question number 6 will be your homework, since it is based on call option. It is based on call option. 2 lakh options to purchase, exercise price 6, market price is 8. It is based on call option. It will be your homework. Basic EPS. I think it is based on right issue. It is also your homework. It is based on right issue. Okay. So now I think 2 hours part is still remaining with us. 2 hours part is still remaining. Like what we need to discuss is contingently issuable shares is remaining portion along with these 2 questions. Then the last question, illustration number 35. Then some questions from questionnaire, like 8 to 9 questions from questionnaire. So if I am not wrong, 2 to 2.5 hours is still remaining for this class. Okay, so let's conclude this session. This session would be called as part 1. Whatever the name of this lecture, this is called as part 1. Tomorrow we will be able to complete the entire part. Tomorrow only we will be able to complete the entire portion. Okay. Tomorrow only we will be able to complete the entire portion. Suppose if in our 3 hours class, suppose if it is completed in 2 hours or 2.5 hours, we will start a new topic also tomorrow. We will start a new topic also. Okay. We will start a new topic also. So guys, let us conclude this session. This session would be called as part 1. It will be uploaded tonight, like in the evening, like maybe after 6 o'clock or 7 o'clock. Okay. Okay. So let me conclude this session. Tomorrow we'll meet at 8 o'clock, and in overall 3 hours class, for tomorrow 3 hours class, we will be able to complete the remaining portion in just 2 hours or 2.5 hours. If remaining time, for the remaining time, we can start a new topic. Okay. So guys, do you want to ask anything? Do you have doubt on this? Tell me. Do you have doubt on this? Tell me. Do you want to ask anything? Do you want to ask anything? Okay, so let's now conclude the session. Let's now conclude the session. Tomorrow we'll meet at 8 a.m. Thank you so much. Thank you so much. Good morning, guys. Good morning, guys. Good morning to all of you. Please do comment or chat on our Telegram group only. How are you? How are you all? Good morning, Riza, Pooja, Sharad. Okay, so let's continue with the remaining points we have for Ind AS 33. This is the pending portion, contingently issuable shares. Contingently issuable shares. A contingent share agreement is an agreement to issue the shares that is dependent on the satisfaction of specified conditions. Now, what is contingently issuable shares? Contingently issuable shares, right? Based on some contingency. Based on some contingency. Like, based on some contingency, like there may be some conditions which are required to be fulfilled in the future. Let us say the targets, some performance. If those conditions will be fulfilled, then only the entity will issue the shares. That means issuance of share is dependent on the performance or on the satisfaction of some conditions. Understood? These are contingently issuable shares. But remember one thing, if there is a condition that I will issue the shares only after 3 years and there is no other conditions, there is only one condition, is I will issue the shares only after 3 years, only after 3 years. These are not contingently issuable shares, because issuing the shares after 3 years, is not contingently issuable share, because here only the time is constrained. Understood? Contingently issuable ordinary shares are ordinary shares issued for the little or no cash or other consideration. Like, we may issue the shares without cash or with little cash, like very small amount of consideration, upon the satisfaction of a specified condition in the contingent share agreement. Generally, these contingently issuable shares are there when there is a business combination. Suppose A Limited is acquiring the business of B Limited. Suppose A Limited is acquiring the business of B Limited, and it was decided that A Limited is issuing or is giving 300 crore of cash consideration. Apart from that, A Limited will issue 300 more shares, 300 crore more shares only after 2 years, if the performance in these 2 years, or if the turnover of these 2 years should increase by 1000 crore. A Limited will issue the shares only when the turnover of each year should increase by 1000 crores. Then I will issue the shares only. So generally, contingently issuable shares are issued in case of business combinations, in case of business combination agreements. As in the calculation of basic earning per share, contingently issuable ordinary shares are treated as outstanding and included in the calculation of diluted earning per share if the conditions are satisfied. That is, the event have occurred. Yes. As soon as the conditions are satisfied, even if they have not been issued, if the conditions are satisfied, but we haven't issued the shares, conditions are satisfied, we haven't issued the shares, understood? Then we can consider these in our diluted earning per share working. Now, how to consider? Please read this point. First of all, from which date these are to be considered for the calculation of weighted average share number of shares? from the date of satisfaction of condition. The general rule is as soon as the condition is fulfilled, you can consider them in the weighted average number of share working. As soon as the consideration, as soon as the condition is fulfilled, we consider them in the weighted average working from the date when condition was satisfied. From the date the condition was satisfied. If the condition is satisfied but the shares are not actually issued, to be considered in basic EPS and diluted EPS. The shares are not to be issued. The shares are not actually issued. You can consider them in the basic and diluted EPS working. If the conditions are satisfied at balance sheet date, but the final compliance date of condition is in future, treat potential equity and include in DEPS only. Now, can you please tell me what is this? This third point and second point. What is the difference between these two? Second and third point. Second and third point. In second point, it says condition is satisfied, but the shares are not actually issued. To be considered in basic EPS and diluted EPS. Third point, if conditions are satisfied at balance sheet date, but the final compliance date of condition is in future. Final compliance date of condition is in future. Final compliance date is in future. Treat potential equity and include in DEPS only. Like in these contingently issuable shares, there was a fixed date that by this date you should satisfy the condition. Suppose we satisfy the conditions in prior. As on balance sheet date, our condition is satisfied, but the final target date is yet to come. Final target date is yet to come. Understood? What to do? Okay, just wait for the target date till the time you can calculate. When you calculate the DEPS, you can consider these shares, but under basic EPS you can't consider. Okay, as soon as the target date is over, final compliance date is over, you can start considering them in the basic EPS working also. If condition is satisfied and the shares are also issued, obviously, then there is not an issue to be considered in basic EPS. Obviously, even the shares are issued, then consider basic EPS working. Consider under basic EPS working. Okay. The main point to be kept in mind for the contingently issuable shares is the word contingent. Contingency involves some amount of uncertainty. It depends on the happening or non-happening of a particular event. Once all the conditions which were earlier uncertain become certain or satisfied, one can include the contingently issued shares in the calculation of basic as well as diluted earning per share. Once all the conditions which were earlier uncertain become certain or satisfied, we can include the contingently issuable shares in the calculation of basic and diluted earning per share. Okay. Okay. Let's start reading this illustration number 23. Let's start reading. ABC company has issued contingently issuable shares on 1st January 2011. On 1st January 2011, ABC company has issued contingently issuable shares on 1st January. The conditions to be satisfied is the average turnover of the company for the last 3 quarters must exceed rupees 100 million. Okay, condition is average turnover of the company for the last 3 quarters must exceed 100 million. If the condition is satisfied, the company will issue the shares within a period of 6 months. Okay. The condition will be effective from the quarter ending 31st March 2011. Okay. Company achieves the said target on ending 31st December 2011. Explain what will be the status of the shares under while calculating diluted earning per share. See, the condition was satisfied on 31st of December. 31st of December. And the condition starts from, the condition will be effective from the quarter ending 31st March. So, when you will calculate the earning per share for quarter ending 31st March, you will not consider them because these are contingently issuable shares and the conditions are not fulfilled. When you will calculate the earning per share for 30th June, quarter ending 30th June, you will not consider them. When you will calculate the earning per share for quarter ending 30th September, you will not consider them. Only when you will calculate the earning per share for quarter ending 31st December or year ending 31st December, you can consider them under the weighted average working. What is the answer? In the above case, company will calculate its average turnover for the last 3 quarters, every quarter starting from 31st March. Average of 3 quarters ending 31st March not achieved. Therefore, share will not be included in the basic as well as diluted. Average of 3 quarters ending 30th June and September, target not achieved. Therefore, shares will not be considered for the calculation of basic as well as diluted earning per share. Okay. Average of 3 quarters ending on 31st December, targeted turnover is achieved. Thus, the contingent condition which was needed to be satisfied is satisfied. Therefore, the shares will be considered for the calculation of basic and diluted earning per share. The date would be considered for calculation of weighted average of shares will be 31st of December. From which date these are to be weighted average? From 31st of December. From the date the conditions are satisfied. If the shares can be issued at any time during 6 months period. Therefore, such shares can be issued at any moment of the time from January 2012 to 30th June. In this case, for calculation of weighted average number of shares for the year 11-12, the period that will be considered would be 1st January to 31st March. For 12-13, the period will be start from April. After 30th June, all the shares will become ordinary shares and there will not be any shares for diluted as the date of agreement is over. Contingent condition is met. So, from on 30th December 2011 onwards, we can start considering contingently issuable shares in the working of basic and diluted. The date will be taken as 31st December. Now, in the next quarter, like 31st March of the next year, 31st March 2012, you can consider in the earning per share working. The shares may not be issued, but you can start considering them. On 30th June 2012, the shares must have been issued. So, these may be considered under basic earning per share only. If attainment or maintenance of specified amount of earnings for the period is the condition for contingent issued, and if that amount has been attained at the end of the reporting period but must be maintained beyond the end of the reporting period for an additional period, then additional ordinary shares are treated as outstanding. If the effect is diluted when the while calculating diluted earning per share. In that case, calculation of diluted earning per share is based on the number of ordinary shares that would be issued if the amount of the earning at the end of the reporting period were the amount of earning at the end of the contingency period. Because earnings may change in the future period, the calculation of basic earning per share does not include such contingently issuable shares until the end of the contingency period. Obviously, when the contingency period is not yet over, you can consider them in diluted earning per share only, because not all conditions have been satisfied. So, if the contingently issuable shares are having some additional conditions, the main condition is satisfied, But suppose there is a compliance conditions, you can consider them in the diluted earning per share working, not basic earning per share working. Okay. Have you any doubt, guys? Do you have any doubt? Do you have any doubt? Okay. Can you guys please solve this illustration number 24? Can you guys please try this question? Illustration number 24. I am giving you 2-3 minutes. Please try to solve this question. Read this. Okay. Yes. ABC company appoints CA X as CFO of the company. Chartered accountant X as CFO of the company on 1st July. Company enters into an agreement with chartered accountant X that the company would issue 1000 shares to her if she can achieve 20% rise in the market value of the shares by the end of the 1 year of her appointment. The current market value of the share is 500. So 500 plus 20%. That means if the market value becomes 600 by the end of 1 year, company will issue 1000 shares to CAX. What will be the status of the shares for calculation of EPS for the year 11-12 and 12-13, assuming the price of shares are as follows. On 31st, we appointed on 1st July. July 11, 30th June 12 is the year date of completion of 1 year of condition. Now here on 31st March 2012, market price becomes 620. Obviously it is more than 600. Yes, it is more than 600, but final compliance date is yet to come. Since the final compliance date is yet to come, we can consider here when we calculate the basic earning per share and diluted earning per share, we can consider these contingently issuable shares of 1000 from under diluted earning per share working, not under basic earning per share working. Why? Because the final compliance date is not over. It was a condition that by the end of 1 year from the appointment date, by the end of 1 year, from appointment date by the end of 1 year, the target must be achieved, 20% rise in the price of the share. Okay, we understood that target is already achieved on 31st March, but final compliance date is yet to come. There may be some chances that it may again reduced. It may be reduced in the next 3 months. So we cannot calculate, we cannot consider these 1000 shares in basic earning per share. We have to consider these in diluted earning per share. Now here the market price was 610. Okay, now the final compliance date is also over. The conditions has been fulfilled. Now we can start, when we start calculating basic earning per share, we will consider these 1000 contingently issuable shares under basic earning per share, even though they are not yet issued, but the final compliance date is over. So under basic earning per share working, we can start considering these shares under basic earning per share working, because it is now certain that yes, I am going to issue the shares. Understood? The next question is, what if the expected market value of the shares is not achieved either on 31st March or 30th June? Obviously, we will not consider them. The required condition was not satisfied on March and June. We will not consider them on while calculating earning per share of March and as well as June. Simple. Have you read that solution? Have you read that solution or not? Have you read that solution or not? Tell me. Have you read that solution or not? Okay, so do you have any doubt? Do you have any doubt? So it's done, contingently issuable shares, it's done, right? Okay, now what about ESOP? I have given you to cover yourself, cover this by yourself only, because this ESOP was similar to call options, similar to call options. Have you done with this? Have you read that ESOP, employee stock options? This question is obviously pending from my side, don't worry. This question, I will cover this question in today's session. So this question is pending from my side. This question is basically for continued, discontinued operations. So please leave this question for now. $610 included in DPS. The condition was 20% increase over 500. So what is 20% over 500? It's 600, na? And by June ending, it becomes 610. Then what will you do? The condition is satisfied. The market price is what? 500. 500 plus 20%. It's 600. That means the minimum price should be 600. On June, it was 610. What to do? We will consider them. Simple. We will, on June ending, we will consider them. So there is no question to ask whether, sir, this is 610, so do we need to consider or not? Obviously, it is more than 600. Understood or not? So what about ESOP? I told you that this is as good as similar to call option. So you have to cover it by yourself. As far as this question is concerned, I will solve this along with you in this session only. So leave it for now. Okay. Now, as far as concept book is concerned, we have done Ind AS 33, covered Ind AS 33, except this question. Except this question. Okay, it's my responsibility to cover. Don't worry. Now, come to the questionnaire. Come to the questionnaire only. Come to questionnaire only. ESOP done. Okay. Like for other students who are not watching me live, for other students, if they have any doubt, you can ask me the doubt on WhatsApp, right? Okay. Now, come to the questionnaire. Come to the questionnaire. Let's start question number 1. Entity has the following preference shares in issued preference shares at the end of 2014. At the end of 2014. Okay. There are 5% redeemable non-cumulative preference shares. These shares are classified as liability. During the year, a dividend was paid on 5% preference shares, and these preference shares are 1 lakh. Okay. These preference shares are 1 lakh. Tell me what to do. These are the 5% preference shares redeemable, and these are treated as liability. Guys, tell me one thing. When we have treated them as liability, definitely the one second. What happened? Okay. Yes. When these are treated as liability, definitely we would have calculated the dividend as per effective rate of interest. Like we would have treated the dividend as interest cost, and definitely this interest cost would already been considered while calculating profit after tax. Okay. See, here the profit after tax for the year is 150. The profit after tax is 150. The profit after tax is 150. So, if you calculate the earning per share, determine the adjustment for the purpose of calculating earning per share. So, as far as this first point is concerned, 5% redeemable non-cumulative preference shares, these shares are classified as liability. During the year, a dividend was paid on 5% shares. Okay, we must have paid the dividend, but such dividend must have been booked as interest because these are treated as a liability, and we must have calculated the interest based on effective rate of interest method, and since it is a liability, such interest must have been considered while calculating this profit after tax. What do you say? See, this is the clarification. The original discount on the issue of increasing rate preferential is treated as amortized to be retained earning and treated as preference dividend for EPS purpose and adjusted earning against the profit attributable to ordinary. There is no adjustment in respect of dividend because these do not commence until 2015. Instead, the finance cost is represented by the amortization of the discount in dividend free period. In the future, the accrual for the dividend of 20,000 will be deducted from the profits. So definitely we have already considered under interest cost. Okay. Increasing rate, cumulative, non-redeemable means these are not liability. The cash is not going to be paid. At a discount in 2010 with a cumulative dividend rate. Okay, I think this was not the clarification in respect of point number 1. As far as point number 1, the clarification comes here. The dividend on 5% preference share has been charged to the income statement because the preference shares are treated as liability. So no adjustment is required for it from the profit. Yes, the point number 3 is relevant for the first item. First item is 5% redeemable non-cumulative preference shares treated as liability. Dividend of 5% preference shares of rupees 1 lakh was paid. Okay. Understood or not? Now the second point, increasing rate cumulative non-redeemable preference shares, non-redeemable, issued at a discount in 2010. Okay, it is our 2014 with a cumulative dividend rate from 2015 of 10%. Acha, the shares were issued at a discount to compensate the holders because dividend payment will not commence until 2015. Okay. See, these were actually issued under 2010, but till 2014, dividend is not going to be paid. From 2015 onward, we can start paying dividend of 10%. And these were issued at a discount. Why discount? Because we are not paying any dividend from 10 to 14. See, originally we issued the preference shares at discount. Why? To compensate the preference shareholders, because we are not going to pay the dividend for the 5 years, like from 2010 to 2014, we are not going to pay the dividend. Okay, but we have issued these preference shares in 2010 at discount. So the discount must have already been considered in the earlier years. Discount must already been considered in the earlier years. The accrual for the discount in the current year calculated using effective interest method amounted to say 18,000. These shares are classified as equity, rupees 2 lakh. Obviously, okay. So overall, these shares are having a value of 2 lakh. Since these are non-redeemable, so these are not liability, these are pure equity. Okay. Now, in 2010, when we issued the preference shares at discount, the discount portion was treated as expense as a form of dividend and amortized every year from 2010 to 2014. So this year amortization is 18,000. Accrual for the discount in the current year calculated using effective rate of interest method is 18,000. So yes, this 18,000 is the amortized discount value. In 2010, when we have issued the preference shares, let us say there is a discount of, overall discount of 80,000, 90,000. And we have started amortizing such discount. So for current year 2014, the discount amount is 18,000. We have to charge it in our P&L. So see this. Amortization of discount on the issue of increasing rate of preference shares, 18,000. So 18,000 we considered while calculating EPS. So our profit after tax is 150. After 150, we have amortized the discount of 18,000 because this 18,000 discount is as good as the dividend. It is as good as the dividend. Understood? What is the clarification? The original discount on issue of increasing rate preference share is treated as amortized to retained earning and treated as preference dividend. So the discount we have given to them to compensate for the dividend for starting 5 years is treated as dividend, and when it is treated as dividend, it must be deducted from the profit after tax. Obviously, now we are assuming that this 18,000 is not considered before profit after tax. Guys, your comment is required, your chat is required. Till now, have you understood the point or not? There is no adjustment in respect of dividend because these do not commence until 2015. Instead, the finance cost is represented by the amortization of discount in the dividend free period. In future, the accrual of dividend of 20,000 will be deducted from the profits. From 2015 onwards, we will deduct 20,000 dividend out of profits. So these 2 points, have you any doubt? Have you any doubt for these 2 points? As far as point number 1 is concerned, it was treated as liability. So when it was treated as liability, interest is calculated based on effective rate of interest method, and we have already covered, we have already debited such interest in our profit and loss account. So these 2 are fine. Okay. Now, the next 8% non-redeemable, 8% non-redeemable, non-cumulative preference shares. At the beginning of the year, the entity had 1 lakh 8% preference shares outstanding, but at 30th June 14, it repurchased rupees 50,000 of these at a discount of rupees 1,000. What is this? Like, this is the beginning, this is the end, this is the beginning. Outstanding was 1 lakh. Here outstanding is only 50, because June 14, right? Buyback or redeemed. At 1000 discount. At 1000 discount. What will you do with the discount? Okay, these are non-redeemable, non-cumulative. So when these are non-cumulative, we have already understood that in case of non-cumulative preference shares, the dividend should not be considered until and unless the dividend is declared. Here, the dividend is not declared. So we will not consider any dividend on these non-cumulative preference shares. As far as this 1000 is concerned, yes, this is our expense. This is our expense. As far as this 1000 is concerned, this is our expense. Okay, this is our expense. So this 1000 will be considered. This 1000 will be considered here. This 1000 will be considered here. Discount on repurchase of 8% preference shares. 1000 will be considered here, right? The discount on repurchase of shares has been credited to the equity, so should be added to the profit. Should be added to the profit means, one second. Wait a minute. The discount on repurchase of the 8%. Okay, sorry. Redeemed at discount, like we have benefit. This is a discount, sorry. Benefit of entity. Since they were redeemed at 1000 discount, so it must be a benefit for the entity. So this is treated as income basically. So this is treated as income basically. So this is the income to be added, right? Any doubt? Any doubt? 18,000 was the discount on issue. 1000 is discount on redemption. Discount on issue is our expense. Discount on redemption is our income. Now, for the last one. Now, please read this last one. Okay? Read this last one. Please try to solve this last one, first of all, by yourself. Yes. The last one. The last one, 7% cumulative convertible preference shares converted in the year, already converted in the year. These shares were classified as equity until their conversion into ordinary shares at the beginning of the year. Okay, these are already treated as equity. No dividend was accrued in respect of the year, although the previous year dividend was paid immediately prior to the conversion. We will not consider previous year dividend because the previous year dividend has been considered in the previous year working only. To induce the conversion, the terms of the conversion of 7% convertible preference shares were also amended, and the revised terms entitled the preference holders to additional 100 ordinary shares on the conversion with a fair value of rupees 300. Okay, that doesn't matter with the for the working of earning per share. So basically, these were converted in the current year. These were converted in the current year. No dividend was paid in the current year in respect of current year conversion. Previous year dividend was paid in the current year, to be ignored because this previous year dividend has been already considered in the previous year working. Some conditions was amended as per the revised terms. These were issued 100 extra additional shares with a fair value of 300. Okay, that doesn't matter with the profit after tax. So obviously there is no effect on our profit after tax. So no effect on our profit after tax. You can read the clarification here. So overall our profit attributable is 1,33,000. Our profit attributable is 1,33,000. Okay. If you have any doubt, you can ask. If you have any doubt, you can ask. Okay, so question number 1 clear. Question number 2 already done. 3 done, 4th done, 5th done, 6th done. 7th was the homework. 7th was homework. Please tell me. Seventh was homework. Okay, 6th was also homework. 6th and 7th was homework. 6th was a basic question. You must have done this. Okay. What about 7th? Even the 7th was based on right issue. Shares outstanding before right 500, right issue shares 1 new share for each 5 matlab 100. Exercise price 5, okay. Date of right issue 1st January. Last date to exercise 1st March. Market price of one ordinary share immediately before exercise of 1st March is 11 rupees. So it is come right. It is come right price. Understood? So basically 11 into 500 shares plus 100 into 5 divided by total 600. It is 10. So 10 is X right price. 10 is X right price. So if 10 is X right price, then the adjustment factor, right factor, is 11 by 10. The right factor is 11 by 10, right? It all happens in 2011 here. So we need to restate the earning per share of 2010 also. As far as 12 is concerned, no effect. Okay. So question number 10 is done. Okay. Now question number 8. Let's start question number 8. An entity issues 2000 convertible bonds at the beginning of year 1. Entity issues 2000 convertible bonds at the beginning of year 1. The bonds have a 3-year term. 2000 convertible bonds at the beginning of year 1. Okay. 2000 convertible bonds at the beginning of year 1. Bonds have a 3-year term and are issued at par with a face value of 1000 per bond, giving total proceeds of 2000 into 1000, that means 20 lakh. Okay. Interest is payable annually in the arrear. In arrear means at the end of every year, at a nominal interest rate of 6%. Okay. Each bond is convertible at any time up to the maturity into 250 ordinary shares. Okay. Conversion ratio is 250 ordinary share for every one bond. The entity has an option to settle the principal amount of the convertible bond in the ordinary shares or in cash. The principal amount can be settled in cash or it can be settled in the form of shares. Okay. When the bonds were issued, the prevailing market interest rate for the similar debt without a conversion option is 9%. Okay. The prevailing market rate of interest for the similar debt without a conversion option is 9%. See, the bonds are having interest rate of 6%. Actual or contractual interest rate is 6%. Now, the prevailing market rate of interest for the similar debt without conversion option is 9%. But the effective rate is 9%. Okay. At the date of issue, the market price of one ordinary share is rupees 3. Income tax is ignored. Calculate basic and diluted earning per share. Calculate basic and diluted earning per share. When the profit attributable to ordinary equity shareholders of the parent entity is 10 lakh, our ordinary share outstanding is 1 crore 20 lakh, sorry 12 lakh. Convertible bond outstanding as 2000. Convertible bond outstanding are 2000. Now please try to listen to me अच्छे से. Please listen to me carefully. Now please, I am starting the solution. See, these convertible bonds These convertible bonds are for 3 years. These convertible bonds are for 3 years, right? Acha. Now, year 1, 2, 3. Cash outflow. Cash outflow. Every year, what will be the cash outflow? In the first year, we have to pay the interest. We have to pay the interest. In the second year, again interest. In the third year, again interest. And in the third year, at the time of redemption, company has an option to settle the principal either into ordinary shares or in cash. That means there is a chance that we may pay cash. There is a chance that we may discharge the cash also. So the cash can be discharged, there is a chance. Redemption in cash, if any. So what we are calculating? We are calculating expected cash outflow. 120 is for sure we have to pay. 120, next 120 for sure we have to pay. Next 120 for sure we have to pay. As far as this 20 lakh is concerned, we may discharge this 20 in the form of shares or in the form of cash. That means chances to pay in cash exist. Okay. Now, present value at 9%. What is 9%? 9% is our effective rate. 9% is our effective rate. So please tell me what will be the present value at 9%? What will be the present value at 9%? 120 divided by 1.0. Tell me, what is the present value? What is the present value? What is the present value, guys? At 9%. The present value will be considered by 9%. So, .9174, 0.8417, 0.772. Here also 0.772. Okay. So if I calculate the present value through calculator with 12 digit working, 120 divided by 1.09, 20 lakh divided by 1.09, it must be 18,48,122. 18,48,122. What is this? This is a liability. This is a liability component. This is a liability component. Now, issued bonds of 20 lakhs, issued bond of 20 lakhs, out of which the liability component is 1848,122. The liability component is 1848,122, and the equity portion, the equity component is 151,878. Now this is based on Ind AS 109 working. Ind AS 109 says when you have convertible instruments, and there is an option to convert them into ordinary shares, or we may discharge the cash also. In that case, you have to classify this overall convertible instrument into two parts, the liability component and the equity component. How to calculate the liability component? The liability component will be calculated by estimating the cash outflows. The liability component will be calculated by estimating the cash outflows. All the estimated cash outflows are to be considered for the present value with 9% rate of interest. 9% is the effective rate which is given in the question. 9% is the true rate. Based on 9%, our present value, that means the liability component, should be 18,48,122. And we issued the bonds at 20 lakh. So the rest part is equity portion. Like the entry will be bank account debit 20 lakh to bonds ब्रैकेट में लाइबिलिटी कंपोनेंट 1848,122 टू बॉन्ड्स ब्रैकेट में इक्विटी कंपोनेंट 151,878. Understood? Please write this first of all. Please write this first of all. Okay, so now please see this. There's a note under these type of instruments. Interest is calculated at effective interest rate on liability component. Like first year interest 1848 122 into 9%. $166,331. This interest must have been charged to P&L of current year while calculating earnings for equity shareholders. Note it. Note this. Note it down, please. Note it down, please. Done? Okay. Okay. Now, this is the profit attributable to equity shareholders, rupees 10 lakh. I am asking you one thing. This is profit of rupees 10 lakh. Do I need to deduct this interest 166,331 from this 10 lakh or not? Do I need to deduct that 166 interest from this 10 lakh, or it has already been deducted and the 10 lakh is the final value? Tell me. Tell me. Should I deduct the interest from this 10 lakh, or the 10 lakh is profit attributable to ordinary equity shareholders? That means what? That means the interest has already been considered while calculating the profit. That means this 10 lakh is after deducting the interest value. Is after deducting the interest value. 10 lakh is after deducting the interest value. This is the final value. Yes. So, and the ordinary equity shares outstanding are 12 lakh. So, 10 lakh divided by 12 lakh, you got the basic earning per share. You got the basic earning per share. So, as far as your basic earning per share is concerned, see this. The basic earning per share will be this. 10 lakh divided by 12 lakh. Understood? But for diluted earning per share, diluted earnings per share what to do? 12 lakh is the profit attributable to equity shareholders plus, suppose these convertible bonds, when they will convert, the interest will be saved. So first year interest is 166,331. There's a saving of interest, 166,331. This is the saving of interest. The saving of interest. If these bonds would get converted, the interest would be saved. Understood or not? Divided by 10 lakh numbers plus. Divide by 10 lakh numbers plus. When the bonds will be converted, the ratio of conversion is 250 for every bond. So there are 2000 bond into 250, like 5 lakh. 250 bond for 2000 numbers. So these are potential equity. These are potential equity. These are potential equity. Please solve this. Working. This is 0.911. Sorry, it's not. Oh, sorry. It's 10 lakh. Here it's 12 lakh. .686 and the basic earning per share was 0.83. So it is diluted earning per share. Guys, clear or not? So it is a good examination question. You must do it for the exam purpose also. Question number 8. This is again a good question. Yes, this is again a good question. Also an exam based question, but different from question number 8. Different from question number 8. Okay, this is again a good question. See what is written. This illustration does not illustrate the classification of components of convertible financial instrument as liability and equity. So this question is not based on the liability and equity component, not like this. No. This question clearly says that in this question number 9, no need to classify into liability and equity component. Okay, then what to do? Profit attributable to the equity shareholders 1 lakh, ordinary shares 10,000. So technically 1 lakh divided by 10,000, it is 10. Basic earning per share is 10. Non-convertible preference shares 6,000 numbers. These are numbers. non-cumulative annual dividend on the preference shares before any dividend is paid to the ordinary shares. The dividend is 5.5 per share. Okay. After ordinary shares have been paid a dividend of 2.10 per share, the preference shareholders will participate in any additional dividend on a 20:80 ratio with the ordinary shares. 20:80 ratio. Compute the allocation of earnings for the purpose of calculation of basic earning per share when an entity has ordinary shares and participating equity shares that are not convertible into equity ordinary shares. Basically, what is the special point? The special point is the preference shares, although they are non-convertible and they are entitled for the normal dividend of 5.5. See, there's a rule that whenever company pays any dividend to ordinary equity shareholders, company has to pay the dividend to preference shareholders first, and then it can pay the dividend to ordinary shareholders. So dividend for ordinary shareholder is 2.1. Dividend for ordinary shareholder is 2.1. Dividend for ordinary shareholder is 2.1. Understood? And before we pay dividend to ordinary shareholders of 2.1, we have to pay the dividend of 5.5 to the preference shareholders. Not an issue. So for calculating profit attributable to the equity shareholders, obviously we basically the preference shareholders are entitled for dividend. But after, when we pay the dividend of 2.1 to the ordinary equity shareholders, the rest retained earnings will again be allocated to the preference and equity in the ratio of 20:80. That means the preference shareholders are entitled for additional earnings apart from 5.5. Preference shareholders are entitled for additional earnings after the payment of dividend of 2.1 to the ordinary shareholders, and they are entitled for additional earning in the ratio of 20:80. 20 for preference shareholders and 80 for equity shareholders. So what will be the actual earning for equity shareholders only? We need to calculate. I want you to just analyze the question and try to solve it. I want you to try to solve it. This is a very good question. Okay, have you tried this question? Have you tried this question? Participating equity instruments and instruments with differential dividend rights. Okay. See this. Since preference shareholders are participating in the undistributed earnings of the equity of the entity, therefore treat them as another class of equity and calculate EPS for them separately. Now, out of total earnings of 1 lakh before dividend payment, we are assuming that this 1 lakh dividend, 1 lakh earning is before any payment of dividend. As far as preference shareholders are concerned, they are entitled for 5.5 per share. That means their earning is 33,000. Equity shareholders, they are entitled for 2.1 per share. Their earning is 21,000 based on 10,000 shares. Now, for the remaining undistributed earnings, that is for the retained earnings, the participating preference shareholders will be eligible. Equity and preference both will participate in the 80:20 ratio. The balancing figure 46,000, preference shareholders are participating in undistributed earnings. Assume X percentage is to be distributed to the ordinary shareholders. Suppose X is the percentage which is for the equity shareholders, equity. So definitely for the preference shareholders will be 1/4 of the X, because the ratio is 20:80. So 20 means it is 20 upon 80 means 1/4. It is 1/4. So if X could be the percentage for equity shareholders, 1/4 of the X will be the percentage for preference shareholders. Okay. Now for equity shareholders, 10,000 number of shares are there into X percentage. Preference shareholders, 6,000 number of shares are there into 1/4 X percentage. When we solve it, the ratio will be like 20:3. The ratio will be like 20:3. We will divide 46,000 of undistributed earning in the ratio of 20:3. That means 40,000 is for the equity shareholders and for preference shareholders it is 6,000. Understood? Now, as far as basic earning per share is concerned, the basic earning per share of preference shareholder will be 5.5 was the dividend, fixed dividend, and 1 rupee is the dividend from undistributed earning. As far as equity shareholders are concerned, 2.1 was the fixed dividend and 4 rupees was the dividend, 4 rupee per share is basically out of undistributed earning. Do you want to write this solution? Tell me. You should write it down, overall things. Please tell me, do you want to write it down? Take the screenshot of this also. Take the screenshot of this one also. Okay. Done? Question number 10. An entity issues 1 lakh ordinary shares of ₹1 each for a consideration of ₹2.5 per share. Cash of ₹1.5 per share was received by the balance sheet date. Okay, we issued 1 lakh shares. We issued 1 lakh shares face of ₹1 each for a consideration of 2.5. I think 1 rupee is the face value, but 2.5 is the issue price, and by the end of balance sheet date we received 1.75. That means these are partly paid shares. The partly paid shares are entitled to participate in the dividend for the period in proportion to the amount paid. Since these are partly paid shares, so they will be entitled for dividend in the proportion of the amount which they have paid. Calculate the number of shares for the purpose of calculation of basic earning per share. It's very simple. See, technically these are 1 lakh shares and the partly paid value is 1.75. Okay, partly paid value is 1.75. That means 1,70,000. If I want to calculate the equivalent number of shares, those are entitled for the dividend only for the purpose of calculating basic earning per share, then I should divide it by 2.5. So equivalent numbers will be 70,000. So instead of 1 lakh, I will consider 70,000 equity shares for the purpose of basic earning per share working, because they are partly paid. They are partly paid. Understood or not? They are partly paid. Clear? So 70,000 shares will be considered because they are partly paid. Okay. Okay, come to this question number 11. Come to this question number 11. At 31st of December 17 and 18, the issued capital of an entity consisted of 40 lakh ordinary shares of 25 each. Entity has granted options that gives holder the right to subscribe for the ordinary shares between 16 and 19 at 70 per share. Okay, there's an option given by the company to subscribe the ordinary shares. The option will be valid from 16 no, sorry, it is 7, 8 and it is 16, 19. Here it is X and here it is Y. That means in 2007 and 8, we have outstanding ordinary shares of 40 lakh. Now company has given an option to subscribe for the ordinary shares in the future, and the offer will start from 2016 to 2019. Okay. Options outstanding on 31st December 17-18 were 630. There were no grants, exercise or lapse of the option during the year. Profit after tax attributable to ordinary equity shareholder for the year ended 31st 7 and 8 5 lakh and 6 lakh. Average market price of the share 120 and 160. Calculate the basic and diluted. See, basic is very simple. Earnings are there 5 lakh and 6 lakh. You just need to divide it by 40 lakhs. As far as diluted earning per share are concerned, company has given some options, and 630 options were outstanding. At the first year ending, the market price is 120 and the exercise price is 70. At the second year ending, the market price is 160, but the exercise price is still same 70. What you need to do? It is as good as a question of call options. You remember the call options of our last class? Call options. So you need to solve it. Solve it jaldi. Immediately. Try to solve it right now. This is the question which is as good as call options. Please try to solve it. Okay. So as far as basic earning per share is concerned, about BEPS, 5 lakh divided by 40 lakh, right? 5 lakh divided by 40 lakhs. This is 0.125. When we talk about DEPS, 630 options are pending. So 630 options into 70 divided by the market price was 120. So it is 367,500. So how much potential dilutive? Potential dilutive are 630 minus 367,500, 262,500. So 5 lakh divided by 40 lakhs plus 262,500. This becomes 0.117. $13 paisa, 12 paisa. How come? 13 paisa, okay. 0.125 means 0.13 and 0.117 means 0.12, 12 paisa. Okay. Same working will be for 2018. Okay, so question number 11 done. Question number 12, leave this question for the time being. Come here. EPS in case of different dividend rights. EPS in case of different dividend rights. EPS in case of differential dividend rights. Now see, read this question, question number 13. Calculate the basic earning per share. Earnings attributable to equity shareholders 6 lakh. 6 lakh. 6 lakh. Equity share capital first class, class 1, 3 lakh 30,000 numbers of 10 each. Class 2, 4 lakh 50,000 numbers of face value 8. So there are different class of equity shares. When they are different class of equity shares, they are entitled for differential dividend. Different class of equity shares may be entitled for different kind of earnings. Class 1 is entitled to 3% extra dividend in comparison to class 2. Wow, what a question it is. Very small question. There are two different type of equity shares, class 1, class 2. Class 1 is entitled for earning, class 2 is also entitled for earning, but class 1 is entitled for 3% extra earning. 3% extra earning. Okay, let us try. Let us try. Since class 1 equity is entitled for 3% extra, for 3% extra dividend. Therefore, the extra dividend will be 3 lakh into 3%, that is 9,000. That is 9,000. You can write it also, okay, simultaneously. Now, total earnings is what? Total earnings are 6 lakh. If we deduct the extra earning, if we deduct the extra earnings, if we deduct the extra earnings, if we deduct the extra earnings, so this 591 are earnings for class 1 and class 2. This is the extra earnings. This is the extra earning for class 1 only. So this 591, out of this 591, both class of shareholders are entitled for earnings. Okay? Correct? Now, class 1, 3 lakh into 12 by 12, class 2, 4 lakh into 12 by 12. So 7 lakh, it is 4 lakh, na? Yes, 7 lakh is weighted average equity share capital outstanding. Weighted average equity share capital outstanding. Weighted average equity share capital outstanding. Why I am calculating weighted average equity capital? Because both are having different face values. Both are having different face values. So, earnings per rupee. Earnings per rupee. Earnings per rupee will be 591 divided by 7 lakh. 0.844. 0.844. 0.844. 0.844. 0.844, right? Earnings per rupee 0.844. So EPS for class 1 will be 0.844 into 10 is 8.44 plus 9,000 divided by 30,000. What is 9,000? 9,000 was the extra earning available for class 1 and their total shares are 30,000. So 8.44 plus 9,000 divided by 30,000, 0.3. So it should be 8.44 plus 0.3. It is 8.74. It is 8.74 per share. EPS for class 2 0.844 into 8. It is 6.752 per share. They are not entitled for extra earnings. So our final answer is 8.74, 6.752. right? Please note it down. Okay, any doubt on this question? Any doubt on this question? No? Okay, let's come to question number 14. Let's come to question number 14. Question number 14. Come to question number 14. XYZ Limited has the following different class of equity of rupees 10 each outstanding as on 31st March. Different class of equity having disproportionate right to the respect of voting and dividend. Each and every class having differential rights to the voting as well as to the dividend. Okay. So for each class we will calculate separate earning per share. 1 lakh numbers for A class of equity proportionate to capital. 30,000 numbers for B class of equity in proportion of 3:2 with respect to A class. 20,000 C class, they are entitled to 5:2 with respect to A class. 40,000 D class, they are entitled to dividend for 3:1 in respect of A class. Understood? Profit for the year is 8 lakhs. Company believes that net profit to be shared in the ratio of 2:3:5:6 as derived from their rights. Basically, it is a wrong calculation. This is a wrong calculation. How to calculate? Come here. How to calculate? Come here. Assume A class is entitled for X percentage dividend. Therefore, B class is entitled for, suppose if A class is entitled for X percentage, then what would be the dividend for B class? B class dividend would be 3:2 with respect to A. 3/2 X percentage dividend. For C class, it will be 5:2 X percentage with respect to A. For D class, it should be 3/1, so 3x percentage for dividend. So A class, if A is entitled for X, B will be entitled for 3/2 of X. C will be entitled for 5/2 of X and D will be entitled for 3x. Right? It is your working note number 1. Now working note number 2. Calculate dividend from above workings. A class are 1 lakh numbers of 10 each. So 1 lakh into 10 into X percentage. B class is 30,000 into 10. They are entitled for 3 upon 2x. C class are 20,000 into 10 into 5 by 2x. And D class is 40,000 into 10 into 3x percentage. When we solve it, it will be 1 lakh into 10, so 10 lakh x percentage. It will be 30 into, sorry, 10 percentage nahi, 30 into 10 into 3 by 2. It is 450 x percentage. 2 lakh into 5 by 2. It is 5 lakh x percentage. 4 lakh into 10, 4 lakh into 3. It is 12 lakh x percentage. Now what is the proportion? Set of x, cut it down, x percentage, 4 zeros, 4 zeros, 4 zeros and 4 zeros. Now the ratio will become 100 is to 45 is to 50 is to 120. 5 ka table, 100 divided by 5. 20 is to 9 is to 10 is to 60. No, not 60 actually. 24. So this is the ratio to distribute earnings. This is the ratio to distribute earnings, right? This is the second working. If you want to note it down, please you can. Okay. Now, what we will do? Now we will divide the total earnings. Where are the total earnings? Total earnings are 8 lakhs. Now, divide total earnings of 8 lakhs in above ratio and calculate EPS separately for each class. Class A, 8 lakhs into 20 divided by 20 plus 9 plus 10 plus 24, 63. It is 253,968 divided by number of shares, that is 1 lakh. It should be 2.54 per share. Now calculate earning per share for each class and tell me the answer. And tell me the answer. Class B, answered by Sharad, 3.81. Answered by Pooja also. Class C, Class C, $6.35. Okay. 6.35. All right. Class D. $7.62. I think it's 7.62. 7.62, I think. Yes. Is the calculation of EPS by the company correct? 158. No, not correct. Not correct. The calculation by company is not correct. Okay. Now please solve this question number 15. Baby Limited has 3 classes of shareholders in its capital structure. Class A 5,000 shares, Class B 1,000 shares, Class C 3,000 shares. Dividend rights attached to this class is 90%, 110%, 100% respectively. Dividend rights 90%, 110%, 100%. Net profit for the year ending is 180. Calculate EPS for each class. Guys, please try it now. Solve it now. Even the hint answers are given. The final answer is given. Please solve it now. Yes, have you got the answer? Have you got the answer? I think A, B, C. A is entitled for 90%, right? So A's share is 5,000. So 5,000 into 10 into 0.9x percentage. 1,000 into 10 into 1.1x percentage. 3,000 into 10 into x percentage. It should be 45:11:30. So total earning 180 into 45 divided by 86. 94186 divided by 5,000. It is 18.84. Rest you can do by yourself. Okay. So this question number 15 is done. Question number 14 done. 13 done. Only one question is remaining. Question number 12. And from concept book, only one question remaining, that is illustration number 25. Okay, so first I will take illustration 25 and then I will take question number 12. Now before taking illustration number 25, see, illustration number 25 is based on some discontinued operations. So we just need to understand some few concepts regarding continuing operations, discontinued operations. Guys, are you listening to me or not? I am not getting any response from your side. Are you guys listening to me? Illustration number 25 is based on discontinued operations, right? It's based on discontinued operation. If you know this clearly, if you remember our first day lecture of Ind AS 33, see this. Ind AS 33 says that you need to present the EPS for continuing operations, you need to present the EPS for discontinued operations, and you need to present EPS for the total operations. You need to present the EPS separately for continuing operations, discontinued operations, and total operations. So this illustration 25, is based on the presentation for continued operations, discontinued operations, and total operations. So it is a very good question, although a new kind of question is this. But before understanding, before solving the question, we have to understand the logics, we have to understand some concepts. Now the concepts are written in my FR chart book. Please open your FR chart book. Please open the FR chart book you have. You must have received the FR chart book along with the entire course, right? So please open the FR chart book, guys. In the FR chart book, there is a page number 24. In page number 24, there is a FR chart, there is a Ind AS 33 chart. There is Ind AS 33 chart. There is Ind AS 33 chart. And on page number 2 of that Ind AS 33 chart, that is page number 25, there's a concept, there's a point number 7. There's a point number 7. There's a point number 7. Now the concept is written here in this point number 7. Okay, concept is written here in this point number 7. What you need to do is, first of all, you have to read the entire concept. Not only read, just understand this concept first of all. Just understand the concept first of all. Like when we have some discontinued operations in the current year, when we have so many operations out of which some are discontinued, so how to present the EPS? So these are the two cases. Just read these two cases, analyze these cases, and then read the question. Question only. Please do not solve the question. I am not saying that you need to solve the question. We will solve the question together, but just understand the concept and look at the question only. Okay? Look at the question only after understanding the concept. Okay? I am giving you 5 minutes. You can say that it is a 5-minute break. It is a 5-minute break. Okay. Okay, welcome back guys. So please read this concept. This says that whenever entity has some discontinued operations, suppose I am dealing in automobile sector, I am dealing in power sector. Now suppose automobile sector is my discontinued operation and power sector is my continuing operation. So I may earn income in continuing operation, I may earn loss in discontinued operation, I may earn loss in continued operation, I may earn income in discontinued operation, anything, okay. Since we need to present EPS separately for continued operation, separately for discontinued and separately for overall operation, so what to do? So whenever company has some discontinued operations, first of all we have to check whether continued operation are having income or losses. In continuing operation, is there any income or loss? Final profit is what? Positive or negative? Is there a net profit or net loss? Whenever we have continued operations, for the purpose of DEPS calculation, for the purpose of diluted earning per share calculation, first of all we need to check in our continuing operation, what is that? Like it is a net profit or net loss. So there are two cases. Whenever there is a net profit, follow this one. Whenever there is a loss in continuing operation, follow this case. So there are two cases. Are you guys with me? Are you guys available? Are you guys listening to me? Tell me. What are these cases? Let us first read the question. 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 Assume the following facts for the company XY. Assume the following fact for the company XY. Income from continuing operation. Okay. So we have income in our continuing operation. So there's a case 1. Definitely the case 1 will be applicable. See, if there's a income from continuing operation, definitely the case 1 will be applicable. Okay. So income from continuing operation 30 lakh. Loss from discontinued operation 36 lakh. Okay. Net loss for the overall operation is 6 lakh. Okay. Weighted average number of shares outstanding is 10 lakh. Incremental common shares outstanding related to stock option. Now what is this stock option? This is basically the potential. This is basically the potential equity. This is basically the potential equity. 2 lakh. Now case 1, if you are required to calculate the basic and diluted earning per share for company XY from the above information. Now since in the above information we have continued operation and in our continued operation we have net income. So we will follow case 1 only. Case 1 says consider all potential shares to calculate DEPS for the overall operation. When you calculate the DEPS for overall operation, since in the question in our overall operation there is a 6 lakh loss. There is a 6 lakh loss. So we have to consider all potential equity shares, continuing, discontinuing. Even though there is an anti-dilution. Even though there is an anti-dilution. What do you mean by anti-dilution? What do you mean by anti-dilution, guys? What do you mean by anti-dilution, guys? What do you mean by anti-dilution? Tell me. Anti-dilution means more than basic earning per share. The value is more than basic earning per share. You guys are really very slow. I must say this, you live students of this batch are really very slow. Anti-dilution means increase in basic earning per share, okay? So, whenever there is a profit in continuing operation, to calculate the DEPS of overall operation, we calculate the potential equity even though there is a anti-dilution. Even though there is a anti-dilution. This is because the EPS of continuing operation gets diluted and income from continuing operation is a control number. Income from continuing operation is a control number. What does it mean? Let us first of all solve the question. Let us first of all solve the question. Now, case 1. Under case 1, what we will do? We will calculate 3 EPS. Continued operation. Please calculate the EPS and DEPS of continued operation. Okay, so continued operation, under continued operation, what is basic EPS? What is basic EPS? Under continued operation, there is a basic EPS 30 lakh income divided by 10 lakh number of shares, 3. What is DEPS, diluted earning per share? 30 lakh income divided by incremental common shares outstanding relating to stock options. So it will be 12 lakh. So it should be 30 divided by 12. It is 2.5. So case 1, under continued operation, we have basic earning per share of 3 and we have basic earning per share, diluted earning per share of 2.5. Understood or not? Now, discontinued operations. If we talk about discontinued operations, then what to do? 36 lakh. 36 lakh is the negative figure divided by 10 lakh. So 3.6 negative EPS. EPS can be negative. We know that. EPS can be negative, 3.6. Diluted earning per share. It will be 3. It will be 3. Okay. It will be 3. Now overall operation. Overall operations. Actually, whatever written in our FR chart book, it is written for overall operation. It is written for overall operation. As far as basic earning per share is concerned, 6 lakh will be the loss divided by 10 lakh. Divided by 10 lakh. So 6 lakh divided by 10 lakh, it is 0.6 negative. Okay. What about diluted earning per share? 6 lakh negative divided by 12 lakh. 0.5. Guys, it is anti-dilutive because 0.5 negative is more than 0.5, 0.6 negative. It becomes anti-dilutive. Anti-dilutive. It is anti-dilutive. See this. Higher the more negative figure is, the more is basically 0.6 negative is there. 0.5 negative is there. So technically anti-dilutive is better than basic earning per share. Diluted earning per share is better than basic earning per share. You can see. Can you see this situation? Here, the diluted earning per share, which is actually the anti-dilutive, it is better than the basic one. Not an issue. Why? Because whenever you have continued operations and discontinued operation, always the public, general shareholders will consider continued operations only. And if under the continued operations, there is a dilution, not an issue, even though the overall operation has anti-dilution, it doesn't matter. See what they have written in our what is written in our chart book. In our chart book, it is written that when you calculate the overall when you calculate the DEPS of overall operation, and suppose under DEPS of overall operation there is an anti-dilution, it's all right, not an issue. Let's continue to present that anti-dilution only. Let's continue to present that anti-dilutive earning per share only because it doesn't matter. वैसे भी, although the shareholders, all the publics are more concerned about the continued operations, so they will consider continued operation as a control number, like for decision making. So for decision making, sorry. Okay, for decision making, we only need continued operation, and if continued operation has the dilutive earning per share, then even though overall DEPS is anti-dilutive, it doesn't matter. Are you getting my point? See, you calculated DEPS for continued operation, you calculated DEPS for overall operation. Under overall operation, the DEPS was anti-dilutive, but under continued, it was dilutive. Not an issue. You can continue to present the anti-dilutive DEPS for the overall also, not an issue, because the shareholders are much more concerned about continued operation, and in continued operation, you have the dilution effect. Then in that case, the anti-dilution of overall operation is to be presented. You continue to present the overall, you continue to present the anti-dilution effect of overall operation, it doesn't matter. Because continued operation is a prime focus area. Continued operation is a control number. All the shareholders will take the decisions based on continued operations only, not based on overall operation. It doesn't matter. Understood or not? But in the second case, C. But in the second case, if there is a loss from continuing operation, EPS from continuing operation will get anti-diluted. This is possible because potential shares in denominator. Therefore, DEPS will be calculated without considering potential. Wow! Without considering potential equity shares. I'll tell you what is the point. Let us now again solve the question. First of all, case 1 is cleared, right? So under case 1, even though the overall operation gives us anti-diluted earning per share, it doesn't matter. We will continue to show this anti-diluted earning per share because our original decision making point is continued operation, and in our continued operation there's a dilution. So don't worry. Okay. Now we'll talk about case 2. Under case 2, assume if in the above case loss from continued operation is 10 lakh and income from discontinued operation is 36 lakh. Okay. Calculate diluted earning per share. Not an issue. Let's calculate. Continuing operations. Continuing operations. Okay, under continuing operations, first of all we will calculate basic earning per share. So 10 lakh divided by 10 lakh negative na, divided by 10 lakh. It is 1 rupee. Basic earning per share is 1 rupee. And if we calculate diluted earning per share, negative 10 lakh divided by negative 10 lakh divided by 12 lakh. It's negative 0.833. It is actually the anti-dilution. Oh my God. Anti-dilution. Can you see the anti-dilution? Because this 0.833 is better than 1. It is anti-dilution from our continued operation. And continued operation is our control number. It is our decision making point. Continuing operation is a control number. Understood or not? Understood or not? Continuing operation. Then discontinued operation. Discontinued operation. Basic earning per share. What was that? Income of 36 lakh. 36 lakh income divided by 10 lakh. So it's 3.6. Okay. Diluted earning per share 36 lakh income divided by 12 lakh. It is 3. Okay. Dilution. Okay. Overall operation. Basic earning per share 26 lakh. How come 26? Because 10 lakh loss of continuing, 36 for profit of discontinued, divided by 10 lakh numbers. 2.6. Diluted earning per share it is 2.167. Okay, anti-dilution, but there's a problem. There's a problem. Our decision making point is not overall operation. Our decision making point cannot be discontinued operation. Our decision making point is continued operation, and under continued operation there's an anti-dilution. There's an anti-dilution. So we cannot show this. We cannot show this even though the overall operation has dilution. Even though overall operation has dilution, but our continued operation, if the continued operation has some anti-dilution effect, the DEPS under continued operation will be continued as 1 rupee only. Matlab same as basic EPS. Same as basic EPS. Do you get that point? So even though under overall operation, there's a dilution, but actually the shareholders will not take any decision based on overall operation. They will take the decision based on continued operation only. And under continued operation, we have to show the dilution effect only, not anti-dilution. So the diluted earning per share will be equal to basic earning per share here. In case 1, under overall operation, there was an anti-dilution. Doesn't matter. वैसे भी they will take the decision based on continued operation and under continued operation there is an anti-dilution. There is a dilution. So even though there is an anti-dilution under overall operation, if continued operation has dilution effect, then we will continue to show this anti-dilution. But we cannot continue to show the anti-diluted earning per share of continuing operation, even if the overall operation has dilution effect. We can't do that. Now, do you get my point? Do you got my point? Tell me. Yes or no? So, overall summary is, your continued operation must present dilution effect only. Anti-dilution effect you can't present. As far as overall operation is concerned, overall operation may have a anti-dilution effect also. It doesn't matter. You can continue to present the anti-dilution of overall operation if the continued operation has dilution effect. Oh, finally, this is also done. The question is definitely relevant for exam. So this is the exam question. So illustration number 25 done. Now we have one single question remaining, that is question number 12. And frankly speaking, it will take some time, even more than 20 minutes. So I am giving you this question as a homework. But please do consider that we have completed our Ind AS 33. Tomorrow's session, we will discuss this homework and we'll start a new topic. Simple. So I am giving you this question as a homework. This question is basically based on contingently issuable shares. This question is based on contingently issuable shares, right? Now this is your homework. In the next session, that is tomorrow at 8 AM in the morning, we'll first discuss this homework and then we'll start our new topic. So finally, we have completed our Ind AS 33. In my opinion, Ind AS 33 is the most interesting, one of the most interesting Ind AS, in my opinion. I would like to know your opinion also. So my opinion is, yes, Ind AS 33 is a very good, very good topic. It is somewhat interesting for students. Sir, next such Ind AS would be Ind AS 36. Next Ind AS would be Ind AS 36, impairment of assets. It's a very, very important Ind AS, guys. Impairment of assets. Next Ind AS is impairment of assets. Okay. Okay, beta. Okay, let's conclude this session. We'll continue tomorrow. Thank you so much, guys. Thank you so much. Okay, good morning to all of you. How are you all? So let's start the session. Yes, we were having a homework. First of all, we'll cover this illustration number 12, sorry, question number 12. First of all, we'll cover this question number 12, then we'll move ahead. I'm not getting any response from your side. I'm not getting any response from your side. Are you guys with me? I think nobody is there. Yes, we shall continue on Telegram only for the live chats. So we shall continue with the Telegram only. Okay? We shall continue with the Telegram only. Who is available currently? Pooja and Sharad. Good morning. I think there was a pending question from my side, question number 12. And apart from that question number 12, anything pending? Is there anything pending? Good morning, Riza. Is there anything pending? Apart from question number 12, is there anything pending? Or any homework question which you want me to discuss? Any homework question which you want me to discuss? No? Okay, let's come to question number 12 and we'll try to discuss it in few minutes. We'll complete in some minutes and then we'll start a new topic. We'll start a new topic, right? Okay, so question number 12. Ordinary shares outstanding during 2011. Good morning, Akash. Outstanding during 2011. Ordinary shares outstanding during 11. 10 lakh. There were no options, no warrants, no convertible instruments outstanding during the period. No options, no warrants, no convertible instruments. Okay. An agreement related to a recent business combination provides for the issue of additional ordinary shares based on the following conditions. As I already told you that this question is based on contingently issuable shares, right? So here they say that we have 10 lakh shares, 10 lakh ordinary shares. Now suppose there is a business combination contract with another company. Suppose we have acquired the business of another company, acquired the control over another company, and we agreed to provide some shares on the basis of fulfillment of conditions. So ordinary shares based on the following conditions. Now what is the condition? Condition number 1, condition number 2. Condition number 1 says 5,000 additional ordinary shares for each new retail site opened during 2001. During 2001. We'll give you 5,000 shares for every retail site opened. Suppose you have opened 4 retail sites, 5,000 multiplied by 4. We'll give you 20,000 shares additionally. We'll give you 20,000 shares additionally. 1,000 additional ordinary shares for each rupees 1,000 of consolidated profit in excess of rupees 20 lakh for the year ended 31st December 11. If the company has earned profit of more than 20 lakhs, then for such excess amount, we'll give you 1,000 additional share for every such excess 1,000. For each of rupees 1,000 in excess of 20 lakh. Okay. So there are two conditions. These are purely contingently issuable shares. We'll give you 5,000 shares for every retail site opened. We'll give you 1,000 shares for every rupees 1,000 for each 1,000 rupees in excess of rupees 20 lakhs profit. Now what about retail site? Retail site opened during the year on 1st May. We opened the retail site on 1st May. We opened the retail site on 1st September. So during the year, 2 retail sites were opened. Okay. Consolidated year to date profit. Consolidated year to date profit attributable to ordinary equity shareholders of the parent entity. 11 lakh. 11 lakh as of 31st March. Okay. They are giving you quarter wise information, like quarter ending first quarter ending 31st March, company earned 11 lakh. Our main condition is 20 lakh. Then second quarter ending. Acha, this is year to date. What is year to date? Year to date is a means cumulative. Year to date means cumulative. This 11 lakh is from 1st January to March. This 23 lakh is from 1st January to June. That means 6 months profit. 23 lakh. It becomes 23 lakh. What was the condition? The condition was 20 lakh. Any profit in excess of 20 lakh. For that excess, we will give you shares. So here 23 lakh, that means it is in excess of 20 lakh. That means from here we can say that yes, we will give you the shares. Rupees 19 lakhs. Oh, From 23 to it becomes 19. How? Because of loss. 30th September, including a 450 loss from a discontinued operation. Overall, it is a loss 19 lakh, 19 lakh cumulative. Like this 19 lakh is from 1st January to 30th September, 9 months overall profit, including a discontinued operation loss, and rupees 29 lakh as of 31st of December 11. So we just need to work on the contingently issuable shares. In this case, we know very well that contingently issuable shares can be considered under basic earning per share, can be considered under diluted earning per share whenever the condition is satisfied. Whenever the condition is satisfied, okay, or when the condition is already satisfied, but the future compliance, but the compliance date is in future, then we need to consider in diluted earning per share, not in basic earning per share. Okay. First of all, remember these some of these points. These are some of the points. Like first, from which date these are to be considered? From the date of satisfaction of condition. Okay, as soon as the condition is satisfied, consider them. Like in our question number 12, the retail site was opened on 1st May. Okay, let's continue from basic EPS working. Let's consider the contingently issuable shares from basic EPS working. If the condition is satisfied but the shares are not actually issued, to be considered in basic EPS and diluted EPS. If the conditions are satisfied at balance sheet date but the final compliance date of condition is in future, then treat potential equity and included only in DEPS. If condition is satisfied and shares are also issued, to be considered in basic EPS. Okay. Now here there are two type of contingently issuable shares, one based on retail site, one based on earnings. Okay, right. Calculate basic and diluted earning per share. Calculate basic and diluted earning per share. Okay. Now we are going to calculate the basic earning per share first of all. We are going to calculate the basic earning per share first of all. See this heading, basic earning per share. Okay. Basic earnings per share. Basic earnings per share. Right. So based on the earnings, see, we have quarter-wise earnings. We have quarter-wise earnings and we have number of shares, ordinary number of shares. Right. So first of all, first quarter earning was 11 lakh. So first quarter earning was 11 lakh. See this. Can you please see this? Guys, are you with me? Tell me, are you with me? First of all, we start with basic EPS, numerator 11 lakh for the first quarter. Now for the first quarter, January, February, March, no retail site was opened. The first retail site was opened on 1st May. First retail site was opened on 1st May. First retail site was opened on 1st May. 1st May comes under quarter 2. Okay. 11 lakh, there is no profit more than 20 lakh. That means under first quarter, no contingently issuable shares are there. Even no condition has been fulfilled. We cannot consider them in our basic EPS. Okay. So we have only 10 lakh shares. So look at this. As far as denominator is concerned, 10 lakh ordinary shares. 10 lakh ordinary shares. Retail side contingency 0, earning contingency 0. Understood or not? Okay. Total shares are 10 lakh. The basic earning per share goes to 1.1. 1.1. The basic earning per share goes to 1.1. Okay. So this is first quarter. This is the first quarter. We can say under first quarter there was no contingently issuable shares. We were having only ordinary shares of 10 lakh. I hope there won't be any doubt. I hope there won't be any doubt, guys. Okay, this is the first quarter. Now come to second quarter. Come to second quarter. Come to second quarter. Now if we talk about the numerator part, the second quarter year to date earning is 23 lakh. It is a cumulative earning. It is a cumulative earning. If 23 lakh is a cumulative earning and 11 lakh is the earning of last quarter, so 23 minus 11, we will get the earning of second quarter. So 23 lakh is the earning from January to June, like 6 months earning. If we deduct 11 lakh, that means first quarter earning from 23, we will get second quarter earning of 12 lakh. 12 lakh second quarter earning. Okay. Akash, why you are not replying? Only a good morning message is not sufficient. Only a good morning message is not sufficient, beta. Okay. So 12 lakh is the numerator. 12 lakh is the numerator. Now as far as denominator is concerned, see, we already have 10 lakh. We already have 10 lakh ordinary shares. Okay. We already have 10 lakh ordinary shares. Okay. Apart from 10 lakh ordinary shares, one retail site was already open on 1st May. The condition is satisfied. On 1st May, the retail site was opened, the condition is satisfied. Now, that means we need to issue 5,000 shares. We need to issue 5,000 shares. Now, when we need to issue 5,000 shares, the conditions are also satisfied. Now, here we cannot say that the condition is satisfied, but the future compliance, final compliance date is in future. No, not like that. So retail site is opened, we have to book, we have to consider the 5,000 shares also. So here we considered 3333 shares. How the 3333 shares are considered? See, 5,000 shares were issued. The retail site condition was satisfied on 1st May. So as soon as the condition is satisfied, we'll start taking contingently issuable shares from the date of condition, from the date of satisfaction of condition. That means 1st of May. So May and June, 2 months are there. So technically 2 months weighted average should be given. So 2 by 3. Out of 3 months, 2 months weighted average should be given. So it becomes 3333. So we took 3333 shares. We took 3333 shares. Understood? 3333 shares. Okay. Sir, what about sir, the second condition? See, the second condition was based on consolidated profit in excess of 23 lakh. So in the second quarter, we got profit over and above 20 lakh. But still quarter 3 and quarter 4 is remaining. They say that for the overall year ending 31st December, our profit should be in excess of 20 lakh. Still, only 2 quarters have been passed. In these 2 quarters, okay, although 20 lakh, although we earned more than 20 lakh, but still we have quarter 3, quarter 4. We can say that in quarter 3 or quarter 4, we may have a loss, and overall it may be less than 20 lakh profit. So here I can say that yes, till date the condition is satisfied, but the final compliance date is in future. Here I can say the final compliance date is 31st of December. For condition 2, final compliance date is 31st of December. Okay, final compliance date is 31st December. So here, as far as these condition 2 is concerned, these contingently issuable shares regarding earnings, we will not consider them in our basic earning per share. We may consider them in our diluted earning per share working, because the final compliance date is in future. So earning contingency 0. You can read point 9. The earning contingency has no effect on the basic earning per share, because it is not certain that the condition is satisfied until the end of contingency period. Your contingency period will end on 31st of December only. The effect is negligible for the 4th quarter and full year calculation, because it is not certain that the condition is met until the last day of the period. Until the last day of the period, basically it is not certain that the condition will be complied. Okay. So basically these shares which are based on earning, we will not consider them in overall earning per share working. Okay, so our total shares becomes 10,33,333. Our earning per share becomes 1.2 for the second quarter. For the second quarter, our earning per share becomes 1.2. Now for third quarter and for fourth quarter, please, only for third quarter, please look into the working. For third quarter, under third quarter, 1st September 2011, another retail site was opened on 1st September. So you have to say that again you have to issue 5,000 additional shares based on second retail site, and that was opened on 1st September. So third quarter is July, August, September. So only for 1 month these 5,000 shares will be weighted average only for 1 month. So 1 divided by 3. In respect of earlier 5,000, now they were outstanding in the overall third quarter. Earlier 5,000 based on first retail site, these were outstanding in the entire third quarter, like July, August, September. So they will be like 5,000. So please look into the solution, like the third quarter working. Please look into the third quarter working. Okay, so under third quarter, we took a loss of 4 lakh. Why 4 lakh? Because 19 lakh as of now, cumulative 19 lakh profit for the entire 9 months. Earlier there was a 23, so overall 4 lakh loss. Overall 4 lakh loss, 10 lakh ordinary shares. Okay, now based on retail side, we have issued 5,000 on 1st May, 5,000 on 1st September. As far as first 5,000, these were outstanding for the entire third quarter, all the 3 months. Okay, as far as second 5,000, they were outstanding only for 1 month. So 5,000 shares plus 5,000 shares into 1 by 3. So we can say it is 6667. So we took 6667, okay, and we have total shares of 10,66,667. We got 0.4 earning per share. We got 0.4 earning per share. Okay. As far as fourth quarter is concerned, we earned 29 lakh rupees for the entire year. 29 minus 19, it becomes 10 lakh. Okay, 10 lakh we have shares. Okay, and now retail site not opened on the fourth quarter, so basically we have 5,000 plus 5,000, 10,000 shares outstanding in the entire fourth quarter. Outstanding in the entire fourth quarter, right? So for the entire fourth quarter they were 5,000, 5,000, 10,000. Okay, so 10,000 shares are there. So 10 lakh 10,000, we got 0.99 basic earning per share. 0.99 basic earning per share. Guys, understood or not? Okay, as far as the full year working is concerned, we have 29 lakh of profit. 29 lakh of profit. We have 10 lakh outstanding for the full year. Now, as far as these 5,000 shares are concerned, 5,000 were issued on 1st May, January, February, March, April, matlab 8 by 12, and the other 5,000 was issued on 1st September, October, November, December, 4 by 12. So 5,000 into 8 by 12, it is this 33 into 4 by 12, it is 1667. It is 5,000. Okay, it's 5,000. So 5,000 shares are weighted average for the whole year. For first quarter, second quarter, third quarter, we were talking about whole quarter. Now here for the full year, we are talking about for full year. 10 lakh 5,000, 2.89 is the earning for the basic earning per share for the year. So yes, this was the basic earning per share working. We haven't considered the second contingently issuable shares based on the profit condition, based on the earning conditions. Okay, why we haven't considered? Because our final compliance date is 31st of December. Till 31st of December, it was not certain whether the shares will be issued or not. Till 31st of December, till the final contingency period becomes over, it was not certain. So how can you take these contingently issuable shares? Now, diluted earning per share. Diluted earnings per share. Diluted earnings per share. Diluted earnings per share. First of all, let me check. I am remembering that there is some problem under diluted earning per share.
Yes. Okay. Yes, there's a problem under diluted earning per share working. Okay, let's continue with the working diluted earning per share. So under diluted earning per share, as far as first quarter is concerned, we have 11 lakh numerator, we have 10 lakh ordinary shares, we don't have any contingently issuable shares because under first quarter, January, February, March, no retail site was opened. Even for the first quarter, no earning was increased by 20 lakhs. So basically, any condition was not satisfied, condition 1 and condition 2 was not satisfied. So overall 10 lakh shares were outstanding. Overall we got diluted earning per share of 1.1, which is same as basic earning per share. So we got 1.1 diluted earning per share. Okay. In BEPS, how 10k in fourth quarter? Since conditions are satisfied in earlier quarters, shares 5,000 share each. Beta 10,000 means 5 plus 5. Beta 10,000 means 5 plus 5. These 5 were outstanding for 3 months into 3 by 3. These 5,000 were outstanding for 3 months, 3 by 3. So it becomes 10,000 na beta. It becomes 10,000. How this 6667 arrives? How this 6667 arrives? For the second quarter, first 5,000 which was issued on 1st May, in the second quarter like July, August, September, they were outstanding on for entire 3 months. Again 5,000 issued on 1st September only, that means the last month of third quarter, that means outstanding for the 1 month only. So 5,000 1667, so 6667 6667. Okay, getting? Okay guys, getting? Now second quarter, second quarter for second quarter we were having earning of 12 lakh, number of shares 10,000, okay, oh sorry 10 lakhs. Now as per my view, here it should not be 5,000, the 5,000 is wrong. Here they have taken 5,000 from my opinion says that instead of 5,000, same 33333 which we have already considered in basic earning per share will be continued. 33333, 5,000 should not be there. 5,000 should not be there. Only 33333 will be considered. What is your opinion? Tell me. What is your opinion? Tell me beta, what is your opinion? See, when we have already considered the retail side condition under basic earning per share, the same will be continued for the diluted earning per share. Now the condition was satisfied on 1st May. Before 1st May, the condition was not satisfied. So technically, you should not take overall 5,000. What they did, they considered overall 5,000. How? As per their view, they are saying that 5,000 shares April, May, June. So they say that in the April, according to their view, it was potential equity, and in May, June, it becomes ordinary equity. As per their view, they are saying that in the month of April it was potential. So when it was potential, so 5,000 into 1 by 3, for 1 month it was potential, and May, June it was ordinary, so 5,000 into 2 by 3, so overall it is 5,000. But as per my view, they were not potential in April because the retail side was not opened. The retail side was opened in 1st May. So in April, no condition was satisfied, and if no condition was satisfied, you cannot consider them even in diluted earning per share also. Under diluted earning per share, it says if the condition is satisfied but the final compliance date is in future, then you can consider them in the diluted earning per share. But here under retail side contingency, in the month of April, no retail site was opened. So for the April month, there were no potential equity shares. From May onwards, only for 2 months, there were ordinary shares. Suppose the retail site was opened on 1st May, we issued the shares on 1st May. They were issued from 1st May only. So as per my view, it should not be 5,000. It should be 3333. 3333. It should be 3333. It is my view. What you guys are saying? Now please tell me what you guys are saying. Please look into this. Okay, so based on that working, it should be 3333 only. Guys, waiting for your response. I hope anybody will give yes sir, condition satisfied only in May, so for 2 months. So basically we already covered here 333. It will be continued here, same figure 333. Okay, in the same way in the third quarter it will be 6667, same 6667. It will be 6667. It is 10,000 fine. It is 10,000 fine. Again, it should be 5,000. It should be 5,000. So as far as retail side contingency, same will be carry forward. 3333, 6667, 10,000 and then 5,000. Why 5,000? I already told you the working. 5,000. 5,000 was outstanding for the 88 months in a year. Another 5,000 was outstanding for the 4 months in a year. So retail side contingency will be like this. Now as far as earning contingency is concerned, in the first quarter we haven't satisfied any condition, but in the second quarter, see, the condition was satisfied but the final compliance date is in future. The contingency period is not yet over. If the contingency period is not yet over, you cannot consider them in basic EPS working, but you can consider in diluted earning per share by saying that yes, the condition was 20 lakh, we already exceeded 23 lakh, but we know that for the next quarters we may incur a loss also. We may incur a loss also. So technically yes, the earning contingency was 3 lakh. Now how the 3 lakh is there? The condition was 1000 shares for every 1000 in excess. 1000 shares for every 1000 in excess. So if you have excess profit of 3 lakh, for every 1000 we will give you 1000 shares. So it is definitely 3 lakh. So under earning contingency it was 3 lakh shares. 3 lakh shares. Earning contingency it was 3 lakh shares. Okay. 23 minus 20, 1000, 3 lakh shares were there. 3 lakh shares were there. Understood? 3 lakh shares were there, right? So total shares will become 13 lakh 5,000. The diluted earning per share will be 0.92. If you can see 1.2 is the basic earning per share, it becomes 0.92 diluted. Okay. Second quarter. Sir, what about third quarter? Under third quarter, the cumulative earning reduced to 19. Oh ho! If the cumulative earning reduced to 19, now we can say the second condition is not yet satisfied. The earning contingency is not yet satisfied. We will not consider here. See this 0. Once again 0 only. 0 only once again. 4 lakh loss, 10 lakh number of shares, 6667. Here it should be 10 lakh 667. So point 39 negative 0.4 0.39 or almost 0.4 is there, 0.397, almost 0.4 is there, almost 0.4 is there. Okay. Now in the fourth quarter, earning increased to 29 lakh. So overall it is more than 20 lakh. Yes, 9 lakh is excess. 9 lakh is excess definitely. So here we will consider 10 lakh of numerator, same. Number of shares 10 lakh, 10,000 or the retail side number of shares, 9 lakh number of shares based on the second condition. 9 lakh number of shares based on second condition. So the total shares becomes 19,10,000. Our diluted earning per share becomes 0.52. Okay. For the final full year, we have 29 lakh numerator, 10 lakh ordinary shares outstanding for the entire year, 5,000 weighted average, because there were 5,000 two times. First 5,000 was issued on 1st May, second 5,000 was issued on 1st September. So if we take a weighted average, it will be total of 5,000. And there is a 9 lakh. 9 lakh is the number of shares potential. Okay. So it is 19,10,000 and 1.52 is the diluted earning per share. Okay. So this was it. Only this working was different. Acha, sorry, even there should not be 1.52, 1910, it should be 19.5 na. So 29 lakh divided by 1905, it should be 1.522. Okay. $1.522. So that's it. This was a question number 12 based on some contingently issuable shares. Guys, if you want to ask anything, you can ask. Because the loss during the third quarter is attributable to a loss from the discontinued operation, anti-dilution rules do not apply. The control number from continuing operation attributable to the equity shareholders of the parent is positive. Accordingly, the effect of positive ordinary shares is included in the calculation of diluted earning per share. Yes, in the third quarter we covered 0.4 only. Okay, is it clear?